almost 8:30 a.m. here in New York City. I'm Brad Smith alongside Akiko Fujita. This is Yahoo Finance, and it's Jobs Day. Happy Jobs Day to all who celebrate. Non-farm payrolls are expected to show a gain of 240,000 for the month here. And of course, we're going to be getting these numbers in just any second now here. This coming after the Fed decided to leave rates unchanged this week. And a lot of the commentary going into and even coming out of that, a resilient U.S. jobs market marked by persistent wage gains is keeping services inflation elevated. That's something that the Fed is going to have to keep on its mind, and it is continuing to discuss in their tenor that's coming out from the meetings. And markets now expecting fewer than 2 Federal Reserve rate cuts in 2024, down from 7 earlier this year. That according to BlackRock Investment.
Yeah, the unemployment rate and average hourly earnings something that investors are going to be keeping a close watch on, obviously because of the concerns around inflation persisting. Expectation here is at 3.8% for the unemployment rate and average hourly earnings at 4%. And you're certainly right. This coming just 2 days after we heard from the Fed chair, taking less of a hawkish tone, certainly going to be very focused there.
Yeah, absolutely. Let's take a look at futures here this morning with about an hour until the start of today's trading activity. Of course, the Dow right now, we're taking a look at that, higher by about 0.7%. The S&P 500, that's also holding on to gains as well by about 0.4%, the futures there. And the Nasdaq futures, the tech-heavy average, higher by about 0.6% on a week that's also been big for tech as well, which of course we'll get back to later on today. But of course, going into the start of today's trading activity and ahead of 8:30 a.m., all eyes are going to be on this employment situation print coming through.
So the question here, at least from the market, certainly jobs going to be in focus today, but is it going to be earnings that's taking the lead moving forward? Now that we've got some of the commentary from the Fed out of the way, we're going to be watching that really closely as we look to that jobs report coming through right now.
We're getting it coming in, and 175,000 jobs added during the month of April. That's the headline. That is softer than the expected 240,000, way softer. And then additionally here, taking a look at some of the other figures, the unemployment rate, that ticking higher to 3.9% versus the 3.8% that was expected. And then average hourly earnings month over month came in at 0.2%, a rise of 0.2% versus the 0.3% rise we were expecting.
Yeah, and take a look at where futures are now pointing. Huge jump on the back of this weaker than expected jobs report, largely because this is sort of put in the context of the Fed, how quickly the Fed is likely to cut rates. You're looking at Dow futures now pointing upwards of 500 points, the S&P 500 futures up 55, and the Nasdaq futures there up 250 points. A bit of a relief, you could say, in the market.
Bad news, good news type of scenario here that we could be watching play out. And the market's certainly saying, okay, well, the Fed's got to do something now if we see a trend of this and there are more softer than anticipated jobs prints. Let's get to Yahoo Finance's Jared Blickery for a check on how futures are moving on the back of this report. Jared, what are you seeing?
Thank you, Brad. We're seeing risk on right now. That is a sense of relief, I think, a sigh of relief. You can see the Dow up now 1.4 points. Let's take a look at the Nasdaq futures, and you can see how they rocketed higher on the announcement. And let's forget, it was only earlier in the week that we got the employment cost index for the first quarter, not a report that usually moves the market. Nevertheless, it came a bit higher than expected. It was risk off on that report. And this is the opposite. Wage growth came in under expectations, so maybe we're seeing some cracks in the labor market. But here's how the bond market is reacting. Here's the 2-year Treasury note futures, and those are surging higher. That means yields are dropping on this announcement. So that is another pressure valve that is being released here. At least that's favorable for risk markets. Let me show you what the 10-year Treasury note futures are doing. Very similar chart there. And then we can take a look at gold. And wow, inflationary. Is this report inflationary? Well, why would that be? It's because the Fed doesn't maybe have to. People aren't worried about that higher for longer scenario. Nevertheless, gold up 0.7% here. Got it checking on Dr. Copper. Not much of a movement there. And finally, Bitcoin. Sometimes Bitcoin has some outsized reactions. Maybe it's going to be delayed, but we're not seeing anything just yet. And I'll leave everybody with the sector action for this morning. And it looks like tech in the forefront. Apple, after those Apple earnings, that's up 2%. That is in the lead. And then utilities, the second best sector, guys.
Okay, Jared, thanks so much for the initial breakdown there. For more on this April jobs report, let's bring in Robert Sotkin, Citi Senior Global Economist, and Dan Gerard, State Street Global Markets Senior Global Multi-Asset Strategist, joining us here. Dan, let me start with you here on your initial reaction to the numbers we got.
Look, it's a bit weaker than expected, but I think we have to keep in mind that it's still a pretty decent number given where rates are. The average in the 2019 pre-pandemic year, which was a good jobs year, was 165,000. We've just had really great jobs numbers for a while. I think eventually we're going to continue to see this higher rates environment bite. But Chair Powell said he needs a meaningful increase to unemployment, and we're not there at meaningful yet.
And Robert, want to get your reaction as well. What do you think the Fed, as Fed Chair Jay Powell is up this morning looking at these numbers, perhaps has his flip-flops on and trying to figure out, all right, what is the next way that we need to be discussing in the inflation picture as it relates to employment and getting these numbers? How do you think this changes the tenor of what they're looking for in a trend in employment weakening to the point where it actually gets them closer to some of their inflation targets?
Yeah, these are great questions. I want to echo what Dan was saying, which is, and of course, it's just 1 month's data, so we need to see how the prints evolve in coming months. But even though it came in below expectations, the number is still a decent pace of job gains. The unemployment rate is still at relatively low levels, and there's some good news for the Fed in this report in that they've been worried, as you noted before, that wage growth has been particularly elevated, which is putting upward pressure on services prices. We had the ECI come in not too long ago at a pretty hot reading for Q1. Wage growth looking a little bit better, at least in the headline in these figures. So it could be that these data on the hiring side, while below expectations, may be pointing to a moderating job market rather than a job market that's falling off a cliff. So it could be a job market that's moving into a soft landing. Or it could be a sign that things are about to slow down much more sharply in coming months. So not enough data here to make a definitive judgment on that. But on balance, I think the Fed's going to be happy that wage growth is cooling, and maybe some of that heat they saw in the job market in the first quarter is moderating to some extent.
Robert, we're seeing a huge reaction here in pre-trade. Dow futures up roughly 500 points there. I realize you are the economist here, but I'm curious if, sort of the market seems to be taking this as bad news, good news, as in maybe this will sort of put the timeline back on here for the Fed to cut rates. I mean, how do you see that? I know it's just one print, but given the numbers that we've gotten today.
Yeah, absolutely. And maybe, as you said, we heard from Chair Powell. Chair Powell is worried about sticky services inflation, the inflation numbers we saw in the first quarter. So that lower wage growth print might be some good news there, some start of some evidence that they can be seeing that they may be able to lower rates later this year. And at the same time, Chair Powell also said that they're worried that the labor market might be softening. And that's another reason that might lead them to start lowering rates as well. So the combination of those things, that you are seeing that moderation, and you're also seeing it on the wage growth side. So both of those things could lead the Fed to cut depending on how they evolve. So that's probably what the market is reacting to. Hopefully, as I said, that these data are moving in a direction that's more of a soft landing, a moderation in the job market and a moderation in wage growth. But we'll need, as I said, more data. But I think that's probably what the markets are reacting to. And
so, Dan, for the markets and the assessment that we've gotten on the back of this print, I mean, we're seeing the futures, as Kiko mentioned, move and swing on this even more into the green. If you're a trader, an investor this morning, and you're trying to figure out, okay, does this trigger any type of massive reallocation or portfolio pivot, what would that be?
Look, I just don't think we're there yet. We're going to see this knee-jerk reaction because people are biased to this idea that we're going to get the soft landing. But in the end, I think that what we're seeing is extreme data. Rates are biting in some places and really not in others because of this post-pandemic normalization that's still going on. So, look, I think we're still in this higher for longer until we get into more of an emergency period. And that's going to mean a eventual more steepening of the yield curve. So I would just be very cautious here of taking on too much risk here. Earnings has been really concentrated in the tech space, and there's still this big expectation that we have a reacceleration of not just earnings, but margins as well going forward, which is going to be tough to achieve.
Robert, looking at sort of the breakdown here in the BLS data, there's certainly been some concern about Jared, just where the economy has trended, this unevenness that we have seen, a lot of focus here on, for example, the black unemployment rate. It jumped at 6.4% in the previous month. We're looking at 5.6%, sort of decreased as well. I mean, when you look at sort of into the numbers here, what does that overall picture look like?
Yeah, it's a great question. As Dan was noting, there's been a lot of swings in the data following the pandemic. I would say on balance, we have seen fairly robust job gains throughout this cycle across the board, fairly low unemployment rates when you average through a lot of the data. And now a lot of that hiring that we're seeing is coming through in areas in recent months like government hiring and some sectors that were very hot earlier in the pandemic, like things like restaurants. Some of the data that we're tracking is looking like that might be slowing down a bit. So there have been a lot of swings in the cycle, but on balance, I would still describe this as a fairly tight labor market that's had pretty broad-based gains throughout this cycle, and one where even in areas that look like they had slowed down some, like the manufacturing sector, we've had a manufacturing slowdown for much of the last year and a half. Even there, you've seen a fair amount of job gains in the U.S. So I would say this is a robust labor market, one where layoffs have been quite low, and broadly speaking, you've seen those gains shared across various industries and types of employment.
You know, just to follow up on that, I mean, as we're looking at the unemployment rate at 3.9%, where do you believe the Fed is going to be watching for that figure to get towards in order for it to feel like it's got a reason, at least based on what they're seeing in the employment situation, to cut?
Yeah, and this is a key question because if you look at their previous forecast, they've kind of been looking for the unemployment rate to rise a little bit to what they see as a more sustainable level. And we're just a little bit shy of where that is now, somewhere around, let's say, a 4% unemployment rate. So I think if the unemployment rate is kind of cruising around these levels or 4%, that, as I said, could still be very consistent with a soft landing. And that's very much what's in their forecast. I think if you continue to see a rise up in coming months and you're starting to get above 4%, then you start to have concerns that at a national level, the SOM rule, which a lot of people track, starts to come into play, where you get a big rise in the unemployment rate relative to its lows from earlier in the year. And that would be a concerning level for them. So I think if you could just hang out at around these levels, I think that they would think they're getting that moderation in the job market and that soft landing they want. But it's a very tricky balancing act because in cycles, when the cycle turns, the unemployment rate tends to turn at the end and tends to turn up very quickly. So it's a very fine line the Fed has to walk.
Yes, Claudia Sahm, the originator of that SOM rule, good friend of Yahoo Finance, and always look forward to talking to her. Always look forward to talking to you guys, too. Robert Sotkin, Citi Senior Global Economist, and Dan Gerard, who is the State Street Global Markets Senior Global Multi-Asset Strategist. Gentlemen, thanks so much for taking the time here this morning. Well, everyone, just to recap here. The jobs for the month of April coming in way below expectations. 175,000 jobs were added compared to the 240,000 that were expected. Later on in the show, we're going to be joined by Acting Labor Secretary Julie Su. You do not want to miss that. Plus, Apple's record-breaking buyback helping shares this morning despite a not-so-stellar quarter for the tech company. We'll bring you those results. Plus, a wild week for Starbucks. Yeah, shares of the green siren hitting the lowest level since 2000? Is that right? 2000? After a brutal miss on earnings, we'll get a Wall Street take on what's next for the company in our brand new show, Catalysts. Keep it right here. We'll be right back. U.S. added 175,000 jobs in April. That's below the expectations of 240,000 jobs. The sectors with the most job gains included leisure and hospitality, manufacturing, and healthcare. We've got team coverage here at Yahoo Finance to break down the hottest sectors. Alexandra Canal, Madison Mills, and Anjali Kamlani are tracking the gains. Ali, let's start with you and the jump that we're seeing in the hospitality industry.
Well, Brad, the jobs added for leisure and hospitality little changed over the month of April, with just 5,000 jobs added to the sector compared to the 42,000 jobs added in the year-ago period. And this is after we've seen a pretty steady uptick in hiring for the sector since February and March. So really, along with healthcare, leisure and hospitality has contributed to the most employment growth since the start of the year. So perhaps we're seeing a bit of a leveling off here as we work our way through the first half of 2024. We did see the unemployment rate for the sector tick up year over year, 5.7% versus the 5% rate seen in April 2023. We also saw a slight dip, I should say, in average hourly and weekly earnings compared to March and February, although wages are still higher on a year over year basis. But again, very little change for this sector over the month of April. And now I want to kick it over to Maddie. Maddie, you're watching manufacturing.
That's right, Ali. Manufacturing jobs having a surprise beat here, up by 8,000 as opposed to the estimate here, which was just 5,000 additional jobs. Now, the reason I wanted to take a look at this is because this could be an indication of a revival in this sector that has really been struggling. I want to take a look at the March numbers, down by 4,000. The prior month in February, the sector lost 9,000 jobs. The Biden administration has been investing in some businesses through some policy like the CHIPS Act in order to beef up our chips production here in the States. Perhaps in some of my sources this morning are already saying this, that we could start to see in these manufacturing numbers the kind of trickle through of that funding into manufacturing jobs here in the U.S. Now, part of that is because there's a delay of about 6 to 8 quarters from that investment to hit this market. So that could be why we're seeing this increase in manufacturing jobs. The last reason this is a big deal as well is that we've been in this downtrend in manufacturing that is very typical to what would happen when you're in a recession. So that's why we've been looking at the manufacturing space, seeing this recovery today, and this beat could be good news for our economy to come. Anjali, I know that you are, as always, watching healthcare for us.
That's right. Healthcare definitely adding a lot more jobs, but of course less than last month, looking at the decline that we've seen month over month broadly of the employment situation, down to 56,000 from last month, 72. So that difference still in line with the average of 63,000. I want to take a look at the segments that have popped up. 33,000 added in ambulatory, 14,000 at the hospitals, and 9,000 alone at nursing care. And that is half of what it was last month. That tells you just kind of what the mixed bag picture is of the industry right now. We know churn is a really big problem across the board in all the segments. Hospitals in particular suffering in this post-pandemic environment where they have had to lean on temp staff and ramping up to meet demand as the seasons show. So we're off of that winter season, so that could explain some of the decline. Meanwhile, ambulatory, an area where outpatient procedures are ramping up, more care is being pushed in that direction, despite the fact that we have an aging population that needs more inpatient care. So all of the numbers month over month are starting to reflect that. And I've spoken to a number of experts about what that means and what the the impact is, because we know that this is an area that, unlike others, is not impacted by inflation. I spoke to Steve Klasko over at General Catalyst, who is a former hospital CEO, as well as working at General Catalyst right now to consult. And he noted that these numbers show we are in a bit of a twilight zone where employment numbers are increasing without the concomitant operating margin increases. And that's because, unlike other areas where, people help with the revenues, the hospitals and the healthcare facilities rely largely on insurers and the government for their income to support the hiring of these employees. So that is really putting pressure on the sector. And despite that, you see the churn and you see these numbers month over month. So that's where the situation stands right now. Back to you guys.
All right, Anjali, thanks so much, as well as Maddie and Ali, for breaking down those sectors. Appreciate it. Well, the U.S. added 175,000 jobs in April. As we've been discussing, that's below what was the expectation, 240,000. There you're seeing it on the screen, as well as some of the other actuals versus the estimates that came in. Let's zero in on wage growth, though. It came in at 3.9% year over year, also below expectations. But how are wages really holding up for the everyday job hunter? Joining us now, we've got Aaron Terrazas, who is the Glassdoor chief economist. Aaron, great to have you on here with us. And I want to get your reaction, first and foremost, to what you're seeing in the wage print part of this employment situation report.
No, thanks for having me. It was a little bit of a relief to see the numbers this morning. For a number of months, it's been safe to take the optimistic side of these bets, perhaps not today. But that wage growth number was a particular source of relief. The reality is there are a lot of different trends happening underneath the surface of it. I like to say we're on a two-track labor market. If you are in the jobs market for high-skilled knowledge workers, it is very much of a buyer's market right now, but if you're in the market for frontline vocational or skilled trades workers, it's still very much of a seller's market.
Yeah, can you elaborate on that a bit more, Aaron, on the latter point that you just made?
Yeah, I mean, you look at the sectors that are still hiring and the sectors that have been really flat over the past year since interest rates have begun to take a hit and companies have changed their hiring postures. There are two very different groups of companies right now. Companies that hire kind of workers with graduate degrees, they have pulled back on hiring, pulled back on wages. Whereas again, for frontline service until perhaps this month, hospitality, leisure, kind of construction, all of those were still going very fast. When you look at the time that workers stay unemployed after a layoff, it has been flat below pre-pandemic levels for workers with less than a college degree. It has been basically flat for workers with exactly a bachelor's degree. It has been skyrocketing for workers with a graduate degree. This is kind of an inverse labor market of most of what we've seen for the past 20 years.
So what does that two-track you just highlighted suggest in terms of the strength of the gains that we saw today?
Kind of the strength of the gains, like the past few months, are still there. They're very real, but we have to keep in mind for all of the agonizing over or soft or hard landing, perhaps the more relevant question is for whom? For whom is this going to be a soft landing? For whom is this going to be a hard landing? And I think there are a number of skilled knowledge workers who are feeling anxious about their jobs, anxious about finding new jobs. And that is an undercurrent that is perhaps washed out in the high level aggregates.
Where are we at right now in terms of the cycle of people that are upskilling or reskilling, trying to get a head start or a jump start on where the future of jobs are coming in from, especially given the wave of investments we've heard about over the course of this earnings season into generative AI even?
When you look at job postings for generative AI, those are way up. Obviously, companies are looking for this skill set. It is a niche that is growing very quickly. I think for the bulk of workers, though, this is a big challenge. They are having a hard time incorporating these new technologies into their day-to-day skill sets and worry about what it means for them long term. But you're right, that is a source of hiring. There is a lot of investment going into it right now. It is still, I think, very much of a niche.
And Aaron, finally, I guess the question that we've been asking over and over is what this ultimately means for the Fed. A weaker than expected jobs report certainly taken as a positive in the markets today, but how do you look at it in terms of the timing of where the Fed's likely to cut?
They needed this report after the string of strong GDP prints, after the string of strong inflation prints. This is a data point, particularly that wage data point falling below 4%. This is kind of the data point that they needed to see to really avoid getting very worried, as I imagine they have become over the past 3 to 4 weeks.
Aaron Terrazas, Glassdoor chief economist. Appreciate you joining us today. Thanks so much.
Thank you.
Brad, that point that Aaron just made about the two-track is really interesting to me because we sort of talk about these numbers as an all-encompassing.
Yeah.
The reality is you kind of weed through the numbers here. Things are not exactly smooth, and his point being, especially we talk a lot about layoffs that have been happening in the tech space. He said, unemployment's rising faster in sort of tech-dependent areas like a California. You do wonder, though, what we keep hearing more and more, at least in that skilled, quote unquote, labor, is that the demand is there, just not in the same areas, the same metros, the same regions that we've sort of become accustomed to.
I'm thinking specifically about how this report feeds into the mindsets for people who are evaluating the employment situation and how that relates to their consumer confidence right now as well. And you think back to the most recent reading, assessments of the present situation had weakened already in April, but relatively optimistic territory is what they remain in. However, one of the areas that they point back to, consumers continuing to rate current business conditions positively, their views of the current employment situation, though, weakened. So this, just a little bit more cold water for the weakening of that mindset around the employment situation. And you got to wonder how that then factors into the broader spending propensity for a lot of consumers out there, and where that starts to also dampen or gets back to that Fed target on the inflation print as well.
Yeah, specifically on the consumer, you have to wonder if this means things start to align. For so long, we've been talking about where the confidence is versus where the action actually is. Right. And in the action and the spending, things have been fairly resilient.
Right. They have been. And I think we're starting to see signs of, and we're hearing this more from economists, where some of that resiliency is starting to be downgraded to, okay, it's healthy, or okay, it might not be as healthy as it was, but it's still moving forward in the areas that are necessities. Now that should, I think that, and we've been talking about that for months at this point, it seems like if people are changing the way that they spend and tapping more into lines of credit or trying to get loans or doing more BNPL, then that's a shift that is not necessarily resilient. It's because they need to do so just to be able to make sure that they're not deploying all of their cash as well in the near term.
Yeah, rising credit card debt, certainly something that we have been hearing about for some time. Before we go to break, though, let's recap those job numbers. 175,000 jobs added, much lower than expected. We're going to chat more about the report on the other side, but we're going to take a quick break here. We'll be right back.
It's 9 a.m. here in New York City. I'm Brad Smith alongside Akiko Fujita. This is Yahoo Finance's flagship show, The Morning Brief.
We've got a lot of ground to cover this Friday morning. Futures are jumping after hiring slowed down notably last month. The U.S. adding 175,000 jobs in April compared to the 240,000 that was expected. Wage growth data also decelerated, a good sign for the Federal Reserve as the central bank looks to cool down the economy and bring inflation to that 2% target.
And Apple this morning moving to the upside. The tech giant announcing a $110 billion stock buyback program and reporting better revenue out of China than expected, showing some optimism that the company's slowdown could be easing. So let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jennifer Schonberger, Jared Blickery, and Madison Mills have more.
Futures rallying after the jobs report clocked in cooler than expected for the month of April. Only 175,000 jobs added on the top line versus expectations of 241,000. Wage growth also coming in cooler than expected at 3.9% versus expectations of 4%. The report is good news for the Federal Reserve, looking for a job market to come back into better balance, offering hopes for a rate cut at some point this year.
And Apple shares climbing higher this morning after topping street expectations on profits. The tech giant also authorizing a $110 billion buyback, largest in U.S. history. But the Mag 7 member still saw some weak spots in Q2. Apple's quarterly iPhone sales plunging 10% in the last year as the company deals with a resurgent Huawei and a slowing economy in China.
And shares in Jack Dorsey's led block are on the move to the upside this morning. The digital payments firm lifting its full-year profit outlook. We're seeing those shares up over 9%. They also announced plans to invest 10% of its Bitcoin profits back into the world's largest crypto asset. Today, less than 3% of Block's resources are focused on its Bitcoin efforts.
Good morning, everyone. Let's take a look at the market action. We've got under 30 minutes before the opening bell on Wall Street. Stock futures higher after this April jobs report came in weaker than expected. 175,000 jobs added versus the 240,000 that we were anticipating. We're also seeing the unemployment rate tick up slightly. There you're seeing where it came in at 3.9%. And then additionally here, the average hourly wages ticking a bit lower, or at least coming in below expectations as well, we should note, for the month.
Yeah, as Jen noted, we saw futures jump on the back of that. We've been tracking yields very closely as well on the back end of that report. We have seen yields pull back broadly here. The 10-year yield is at 4.49 right now. We've got the 30-year yield on the longer end at 4.65. Also, though, earnings still very much in focus. We've seen the Nasdaq futures up in a big way on the back of better than expected Apple results, although you could argue the expectations were set pretty low.
Yeah, that's right. You're taking a look on the far right corner, or the far, well, for the people who are watching at home, the far corner of your screen here, one way or another. They're higher right now by about 7.2% coming into the start of today's trading activity on the back of that report that you mentioned here, and taking a lot of the broader tech names with it that we've already heard from over the course of this earnings season. Of course, NVIDIA is a little bit later on in the season as well to hear from.
Okay.
Also, let's kick things off with that weaker than expected jobs report. The Fed has been touting the strength of the labor market, using it to bolster their higher for longer rate argument. So how might this report affect the Fed's monetary policy pathway moving forward? Here with more, we've got Yahoo Finance's Jennifer Schonberger. Hey, Jen.
Good morning, Brad. The job market clearly cooling in the month of April to kick off the second quarter, with non-farm payrolls coming in much lower than expected at 175,000 for the month versus expectations of 241,000. And in particular, wage growth coming in below expectations at 3.9% versus 4% expectations. All of this underscoring that the job market is cooling and coming back into better balance, exactly what the Federal Reserve has been waiting to see. specifically on wage growth, that clocked in at 3.9%. Fed Chair Powell said on Wednesday that while the Fed does not target wage growth will probably need to tick down a bit to see sustainable wage growth. If we look at the numbers, 3.5% wage growth would probably be more sustainable in terms of what the Fed's targeting for 2% inflation. So today we're at 3.9, so certainly some encouragement there. Now, while the job market is coming back into better balance, it is the inflation side of the mandate that the Fed is bulking at. Powell said on Wednesday that he believes the job market can continue to move and to grow in a strong manner, and inflation could continue coming down. Take a listen to what he said.
Remember what we saw last year. Very strong growth, a really tight labor market, and a historically fast decline in inflation. I wouldn't rule out that something like that can't continue. I don't like to say that either strong, either growth or a strong labor market in and of itself would automatically create problems on inflation.
Powell said he believes that the job market can continue to outperform, as you heard just there, with inflation coming down. He doesn't think that we would need to see weakness in the job market or the economy necessarily for inflation to come back down. But today's report offering some hope to the Fed that perhaps we could see some gentle cooling in the job market. We'll see what this means for inflation going forward here in the second quarter. Guys.
Okay, Jen Schomburger with the breakdown. Thanks so much for that. Well, let's keep it on the April jobs report. We are seeing some easing in the data. The U.S. adding fewer jobs than expected. The labor market potentially coming into better balance here. So what does this mean for the Fed and the economy moving forward? Here with more is Satyen Pandey, S&P Global Ratings Chief U.S. Economist. Good to have you on today. You know, we had a guest on earlier, City Economist, who said, look, if you can kind of hang out around these numbers, you're going to get that soft landing. And Jen just breaking down the data for us right now. But does the Fed have at least the labor market kind of where it wants it to be?
Yes, it does. This is exactly what they would want the soft landing picture to look like, a gradual slowdown. I think they're getting what they had been expecting for a while now, sort of a 200,000 3-month average job pace for the private sector. And when you look at the details, the wage growth also slowing down only gradually. I think all in all, this does paint a kind of a soft landing picture coming to scope, at least as we go through the course of the year.
Okay, so at the point that we would expect at this point, I mean, we're looking at September as the earliest that we could potentially see a rate cut, and December was the second one that many economists have been hoping for or pontificating on. What is your expectation there?
So we are expecting a December rate cut at the moment, and that's conditional on the path of the inflation. The upside surprise of the first quarter basically led us to change our Fed call, moved it back to December. But again, it is very much conditional on how the next CPI inflation data, the PCE inflation data, they come in. I think today's wage growth that came in for April, that was as very close to expectations, at least directionally. So that should help, at least on the service side of this inflation, to reassert itself in the data.
The headline number today coming in weaker than expected, but as our guest noted earlier, it is still a pretty resilient number when you consider where we are in the cycle. To what extent has immigration, you think, contributed to these consistent job gains that we have seen month after month?
So I think in the last few months, we have come to find some evidence. There have been lots of research out showing that we have been undercounting population growth in the U.S. basically due to the immigration, rising in the last 1.5 years. So I think that does sort of explain some of the upside surprises, and it does also help in some of the wage growth tempering. But overall, it's sort of, it goes both ways. They both, they produce and they also consume at the same time. So it is a net positive so far in normalizing the labor market, as well as keeping the economic growth sort of getting surprised on the upside. So Yeah, immigration has been a key factor, especially in terms of inflation neutral job gains, right? So it seems like rather than 100,000 that most folks think about for the longer run job gain to be inflation neutral, it seems like at least temporarily it has increased to about 175 to 200,000.
And so with that in mind, I mean, we're seeing a lot of potential new jobs that are going to be earmarked for companies, and whether that means kind of reallocating certain positions that they already have within their headcount or trying to figure out where they add on to the existing workforce that they do have. A lot of that has really been spurred by some of the latest technology type of investments that they've made. How much of that do you think is going to be driving the employment situation, especially if we do see a broader pullback in the amount of hiring that gets done?
Well, when you're at this part of the economic cycle, when you've gone through this expansion and we're at full employment, more or less, you do tend to find normally more, investments in technology, more of the labor productivity gains coming from such investments. And I think this is something normal for this part of the expansion. Even when you look at the past cycles, I would expect this to continue in the coming quarters, and especially with the AIs of the world, where it does look like it is a complement to a lot of the service side of production for the labor force. It should be that these kinds of investment will continue on, at least in the near term.
All right, Satyam Pandey, who is the S&P Global Ratings Chief U.S. Economist. Satyam, great to see you this morning.
Thanks for having me.
Absolutely. Well, Apple shares climbing higher this morning after topping estimates in the second quarter, but saw total sales fall over 4%, and iPhone sales in particular declined 10% from a year ago. The tech giant did, however, announce it authorized a $110 billion share buyback. Martin Yang, who is the Oppenheimer Senior Analyst of Emerging Technologies and Services, joins us now. Martin, great to see you here this morning. So perhaps it was better than feared in some cases, plus buoyed by this buyback that was announced as well. I mean, all things considered, how should investors still be evaluating Apple right now?
Sure. So I think you started framing this exactly what I thought is, with iPhone a cycle likely going out of the trough, and then with a stronger shareholder return program that will stabilize investor sentiment. And from here now, we're going to enter into a stronger iPhone cycle with accelerating earnings growth from low single digits to double digits, and likely will put Apple, the stock, on a premium valuation versus S&P.
Martin, I just have to throw this number out when we're talking about the buyback, because I think it puts this in context. The $110 billion buyback, by the way, is from the Journal, more than the market cap of most S&P 500 companies. I mean, that just tells you the size of it and why we're seeing this kind of bump on the back of the results. At the end of the day, though, this is a company that's still being judged very much on iPhone sales. Is that a risk when you consider ultimately that these upgrade cycles are slowing, even if the expectation is there is going to be one super cycle coming out of AI?
I think the upgrade cycle is definitely lengthening when you look at the past maybe 5 to 10 years time horizon. But at the same time, we are seeing a very steady increase of Apple's services growing as a percentage of both revenue and profit. So with each new cycle, Apple is able to strengthen its position regarding services, allowing more users and to subscribe to more services and pay more per service and per subscriber. So this is not only an iPhone story, but an iPhone Plus services story.
And so at what point do you foresee services, I mean, we've been tracking this getting, back in 2020 to an $80 billion run rate, and now we're looking full speed ahead at when this is going to get to a $100 billion run rate even. I mean, what type of timeline do you think Apple is on to be able to reach some of those high marks and then those margins pass back through to other elements of the business that they'd like to see grow up?
We're already going to see services passing $100 billion run rate in 2 quarters, according to our estimates. So that $100 billion mile mark is very easy to break through. And when you think about how Apple will allocate the additional profit generated by services, I think for now, in the near term, I think it will be wise to plow the profit back into investment into AI as well as machine learning, both on the infrastructure as well as on consumer-facing applications and features on the phones.
Martin, what's the next big catalyst, you think, for the stock?
In early June, there are two. I think it's twofold. The smaller catalyst, what we'll see in next month, next week, where we are going to see the new generation of iPad Pro launching. And this will be iPad with not only a new display, but also expected to have a very capable laptop grade chip. So you'll see, a very exciting development and evolution in the form of iPad next week. And then in June, that's the bigger catalyst. At WWDC 2024, we'll see Apple formally announcing, really Gen AI features that will come to the next iPhone.
What does the evolution of the headset need to look like? I mean, people who have one, it sounds like they enjoy it, but the price tag needs to come down. I mean, for me, it's kind of clunky right now. So what do you need to see to have confidence that that could be a significant contributor to Apple's bottom line in the future?
Now, I have no confidence in Vision Pro or similar headsets becoming a significant contributor to Apple in the next 5 years. There are some serious, very difficult physical problems to solve regarding optics and how you can present a very comfortable visual experience for our average consumer, and those are really difficult problems. I don't see near-term solutions for those. So the weight and form factors is going to be too much of a barrier for Apple to break through in the next 3 to 5 years.
Are they wasting their time then, sinking cash into that venture and that part of the business?
No, so that's exactly what Apple should do as one of the most financially resource-rich company, because they are investing not only for near-term projects but longer term. Eventually, they will need to push forward on new form factors, new ways for us to think about new form factors for personal computing, and wearables is definitely one of the key directions that makes sense because it really liberate our hands, allow us to be more productive.
Martin Yang, Oppenheimer Senior Analyst of Emerging Technologies and Services. Good to get your insights today. Appreciate the time.
Thanks for having me.
Well, shifting to the healthcare space, Amgen shares surging this morning after the company's CEO said they are very encouraged by early results from its obesity drug. Yahoo Finance's Anjali Kamlani here with the details. Anjali, it's interesting. The conversation around this has been, well, what does this mean for a company like Novo Nordisk? You say it just points to the scale.
Yeah, I think that we have to remember that the market is so big. The addressable market is so big for this product. And the way that Amgen is getting into it is backing into the obesity space, whereas others started off with the diabetes space and then came in. So let's take a look really quickly at what Amgen told us yesterday, which was that the phase 2 results, the initial data that they've looked at is positive. We're expecting the full data later in 2022. The phase 3 trial has yet to begin, and that's really where you're going to see the actual results, the actual benefits, and have comparable data to what is already on the market. We did see a hint of that, which got everyone excited, which is that phase 1 showed that it's close to the 15% that Novo and Lilly have set as the bar. So that's what they have for the drug Maritide. We heard Amgen CEO Bob Bradway saying that following the interim analysis, they're confident in Maritide's differentiated profile. What that exactly means is unclear, and that's what we're waiting to see, is why they're so confident, what exactly they see as differentiated compared to others. That one hint is that it could be taken fewer times than the current pace for the other injectables. So that's something we have to see, and that's what analysts are basically warning, that while this news is positive, we do have to keep our eye on the fact that it is just phase 2 right now. JPM saying that while the update isn't encouraging, they need the full phase 2 data in order to evaluate the potential role in this evolving obesity space. And so just a reminder that Amgen's starting in obesity, going into diabetes, but there's also so many more areas where there are potential for GLP-1s.
All right, Yahoo Finance's own Anjali Kamlani, thank you, breaking down all things Amgen this morning. Thanks so much, Anj. Appreciate it. Well, everyone, we're just getting started here on the morning brief. Fill up that coffee because coming up, April jobs report coming in well below expectations. The U.S. economy adding 175,000 jobs in April, lower than the 240,000 that was expected. We'll be joined by Acting Labor Secretary Julie Su later this hour. Plus, what will happen next for Paramount? Big question there. Apollo and Sony submitted their offer letter for the company in the latest plot twist for the buyout. We'll discuss what could be next after the break. And later on, DraftKings reported a surge in revenue and raised full-year guidance. CEO Jason Robbins joins the show. That's an interview you do not want to miss. Keep it here. We'll be right back. Block shares jumping, as Destiny's Child would say, after posting a 22% jump in gross profit from a year ago and announcing every month they will invest 10% of gross profit from Bitcoin products into buying Bitcoin as an investment. CEO Jack Dorsey also writing in a letter to shareholders that Bitcoin will help the company, quote, serve more people around the world faster. He has been a noted Bitcoin bull over the years, so this should come as no surprise. This is not a shift in tenor at all. In fact, it's just doubling down even further here. And as it relates to where they expect some of the guidance here for the full year to move towards, they actually raised their guidance for the full year for both gross profit and profitability, reflecting the Q1 outperformance, but also reflecting some of the expectations for the remainder of the year. They mentioned also some of that attributed to the growth that they've seen in Cash App's gross profit as well. But that's moderated slightly from the first quarter here.
Yeah, Block getting a big pop, at least in pre-market trade there. Baird raising their price target to $100 from $98. Yeah. Not a significant upgrade here, but keeps outperform rating, saying that yields on volume MAUs look good across the Square Seller and Cash App as well. Let's move on to another stock we're watching. Coinbase shares moving lower after its monthly transaction users fell 5% from a year ago. But the company did still report its second consecutive quarter of profit, driven by a boost in crypto trading during the first 3 months of 2024. Brad, been looking through some of the street notes here on the back end of it. It's interesting, a bit of a divide, you could argue. Dan Dolev over at Mizuho saying that the Q1 beat was widely expected, but he says that the large chunk of revenue coming in from altcoins and staking that's subject to regulatory scrutiny. So that could be a potential risk. On the other hand, you've got Trevor Williams from Jefferies saying the Q2 transaction revenue is trending well ahead of expectations, and subscriptions and service guidance is also ahead as well. So a bit of good and bad, I guess, if you sort of look at where the street is on the stock.
Yeah, I mean, well, over the past 52 weeks, up 345%. So ultimately, I think there is a lot that this company also has to continue to prove that it can iterate on top of. And it seems like some of the reports going forward from here might be Goldilocks reports where they really have to hit it right on all cylinders in order to impress investors from this point.
In the Q1 performance sort of expected because of where we saw Bitcoin track in that period.
Exactly.
Well, Paramount shares paring back its gains after closing up 13% following news that Sony and Apollo have made a joint $26 billion all-cash bid to buy the media giant. Yahoo Finance's Ali Kanal is always on top of the details for us this morning. Ali.
Hey, Kiko, that's right. Sources confirming with me that Apollo and Sony have formally expressed interest with that $26 billion all-cash bid. The deal would make Sony the majority and controlling shareholder, with Apollo operating as a minority shareholder. Now, together, both Sony and Apollo are standing by the equity, so no need for any financing. And this was a big area of concern when Apollo first submitted its bids earlier this year. Remember, we saw the firm submit an $11 billion bid for the studios business and then a $26 billion bid for the whole company, both of which Paramount initially rejected. But this integration with Sony, that makes things a lot more interesting. And clearly, shareholders also seem to prefer this deal as well, considering the share reaction we saw yesterday. But remember that at the end of the day, this all comes down to Shari Redstone, Paramount's controlling shareholder. And it seems like she wants to get a deal done with Skydance Media. This deal is a lot more complicated. We've already seen non-voting shareholders express their concerns and frustrations over what this deal could mean for potential share dilution. But Skydance has made certain amendments. The company has been negotiating with Paramount for about a month now, the exclusive negotiation window officially expiring today. Of course, it's always possible that talks could be extended, but that's where things currently stand. I do believe there will be some sort of a deal, but when and who wins out, that's the big overhanging question. Akiko, Brad.
All right, thanks so much for that, Ali. Well, we are just minutes away from the opening bell on Wall Street. All three major indices firmly in the green after a weaker than expected jobs report out today. We're going to take a look at how the trading day is shaping up. That is coming up right after the break.
We're a minute inside to the opening bell here on Wall Street as we're taking a look at the U.S. futures coming off a weaker than expected jobs report for the month of April. Futures rejoicing in a bad news is good news type of reaction here that we're seeing this morning. The Dow futures holding on to gains of 1.25%. The S&P 500 and the Nasdaq also rocketing higher. The Nasdaq up by about 1.8% right now coming into the start of trade.
Yeah, big gains going through into opening trade here on the back of a weaker than expected jobs report there. The expectation here that the Fed sort of back on track here in terms of cutting rates. At the same time, earnings still very much in focus. We're going to be watching where things stand in terms of the tech trade. There you have it, the opening bell. As we look on this Friday, happy Friday, Mexican consulate up there over at the New York Stock Exchange. Let's do a quick check of the market, sponsored by Stacy Trade. As we were saying, very much the driver, at least in early trade, certainly going to be that jobs report coming through here, weaker than expected as we look at where things stand right now. The Dow up 530 points there, and the Nasdaq gaining as well as is the S&P 500. Oh, wow. Nasdaq's going to be an interesting one to watch, Brad, especially given Apple's results yesterday. Expectations set very low here, but coming in much better than expected. And of course, we are watching the yields all pulling back, at least initially, on the back of that data. Yeah, there you're seeing the 5, the 10, and the 30-year all down right now. You're seeing it for the 5-year sitting at about 4.47, lower over the course of the past 2 days, and really the move here today lower by about 2.2%. Let's take a look at some of the early sector moves that we're seeing out of the gate as well. You've got all 11 S&P 500 sectors in positive territory right now, led by technology off of the back of that Apple report, as well as just looking across some of the other reports that we've seen over the course of this week coming out from some of those Mag 7 names, which many of the analysts who we've discussed could be Mag 4, Mag 3 even, depending upon where we see these returns continue to move as well. Yeah. But yeah. Well, I was going to say we'll take it. We'll take the positive note here on this Friday. We are continuing coverage of the opening bell on Wall Street. Our very own Jared Blickery at the big board looking at commodities. Jared, what are we looking at?
Yes, Akiko, to discuss commodities, we got to take a look at the dollar as well. But behind me, you're going to see our commodities heat map, more green than red. And we have more green in part because we have a weakening dollar. In fact, we got a pretty strong reaction to the downside. This is the U.S. dollar index intraday. And this shows you what happened after that employment situation report. Now, if I put a year-to-date chart in, you can see we are off of these highs now. And on a 5-year chart, we've simply been in a trading range. We hit the upper bound, and it might be reasonable to expect that we're going to hit the lower bound. So 104.79. Next stop down is about 100, 150. We'll have to see if that happens. In the meantime, we are seeing some outsized action. Here's copper. That is at multi-year highs. These highs over here hasn't exceeded $5, but it's at $4.55 right now. Dr. Copper saying the global economy looking strong. Now we got to take a look at gold. I'm going to give you a 5-day look because we've had gold fall off. It's had a couple of sell-offs this week, including a little one this morning, but 2,300 seems to be about a support level that it's in play right now. Also want to check out crude oil, which is now down 0.5%. This is a 5-day look, and it's just been a slow, steady downward trend here. So for WTI now holding below $80. Send it back to you guys.
Okay, thanks so much for that, Jared. Our very own Jen Schomburger standing by with Acting Labor Secretary Julie Su there for the latest on that jobs data that came out this morning. Jen.
Thanks, guys. I am indeed here with Acting Labor Secretary Julie Su. Secretary Su, thank you so much for joining me.
So good to be here with you every month.
Great to be with you every month as well. We saw a cooling in the job market last month to kick off the second quarter. Is this the beginning of a sea change?
No, this is a continuation of the strong, steady job growth that we have seen since President Biden came into office. We've now seen over 15.4 million jobs created. The unemployment rate remains below 4% still. That's the 27-month straight. And labor force participation rate for prime age workers continue to tick up. In fact, for women, it's the highest ever on record. And we started recording this data back when President Truman was elected. It's the highest since that moment. And so we are just seeing not just historic job gains, but broad-based job gains.
And what about wage growth in particular? Because we saw that tick down to 3.9%. Expectations were for 4%, which would have been in line for the month prior. Do you think that that is a moderation or perhaps signs for bigger cracks?
I think that, because wages continue to outpace inflation, that's a good thing. Very fundamental to the president's vision for this country is that working people do well. And when working families have more money in their pockets, they have more breathing room. That is a sign of Bidenomics working. And so wages continue to go up, especially for low and middle income Americans, which also leads to, more equity, more of a fair share.
Prior to the pandemic, the understanding was that we needed to add 100,000 jobs a month to keep up with population growth. Now that we've seen a surge in immigration, the understanding, there's a new report out, I should say, from the Brookings Institute, which estimates that that's actually doubled to 200,000. And economists seem to be in agreement with that. Are you in agreement with that? Do you think that this economy needs to add more jobs per month to keep up with population growth? And if that's the case, what does that mean about the strength of the job market?
I would say that the numbers, not just this month, but every month, demonstrate continued strength. And what the president said over a year ago now was that 150,000 was about the right number. We have been steadily moving in that direction after the extremely hot growth that we saw initially in 2021. And the increasingly steady numbers that we've seen throughout 2022 and 2023. And 2024 remains, strong when it comes to growth in industries that were devastated in the pandemic, and in a way that is, showing that, again, over 50 million people since the president came into office are in jobs, are bringing home an income that allows them to afford the basic things they need in life.
We got to get you a cup of water here. I want to ask you about productivity for the first quarter. Those numbers showing a bit of slowing. Granted, one report does not make a trend, but are you worried that productivity is starting to wane?
That's a very important point about why we look at numbers each month, but why we also look at overall trends. And the overall trend in the economy is that productivity is up. That means when we talk about workers getting their fair share, that also means that the overall pie is bigger. And when the overall pie is bigger, that provides more opportunity for more working Americans too. And so what we want to keep on seeing is productivity increase while wages increase, so that, again, working people enjoy the gains in that productivity that they make possible.
Switching gears a bit, Secretary, I want to ask you about the rule that the FTC recently passed last week, basically to ban non-compete clauses in employment contracts. Barring any legal challenges, how do you see this impacting the labor market?
It's one of many things that is happening under the president's leadership to make sure that working people get a fair shake, that they have more flexibility, right? That this is a way of empowering working people. And we come here every month and talk about the numbers, which are really important. But the numbers are only one part of the story. So rules like the one that you mentioned is also how the president is delivering on his promise to build an economy from the middle out and the bottom up, where working people do well. We've also announced other rules that are part and parcel of that big vision. Well, we are restoring the 40-hour work week for millions of working Americans through our overtime rule. We are making sure that retirement security is real, so that American workers can retire with dignity. We are seeing and delivering for workers who've been left out of our economy for too long, from mine workers to farm workers. So that rule, like our others, are really about prioritizing working people as we build this economy and make America strong.
You mentioned briefly the overtime rule. I want to drill into that a little bit more. You finalized that rule last week. There are two thresholds for salaries now. One kicks in July 1st. The next one kicking in the beginning of next year, January 1st. What impact do you think that's going to have on employment in this country, as well as the economy overall? Because on the one hand, it may help workers' wages, but on the other hand, I wonder how employers are going to look at this.
So the reason why there are overtime laws in this country is because we both want to make sure that when workers work longer hours, they are compensated for it, right? It's part of the promise of a fair day's pay for a hard day's work. And also, historically, it was to make sure that, working people didn't have to work too much, too long of hours. Our rule now restores that basic promise. So when overtime rules were first put into place, the salary threshold, some 60% of American workers were eligible for overtime based on threshold. In the last administration, that number dropped to the single digits. So we are restoring this to basically, making sure that millions more Americans who work over 40 hours in a week get the pay that they deserve. And either, they're going to get more money in their pockets, which, as we've talked about many times, is good for the economy, it's good for spending, it's good for working families, or they're going to be able to work a little bit less, which will also mean that they'll have more time with their families.
And before I let you go, we always talk about women and the economy and the job market. Women's participation in the labor force hit an all-time high,
That's right.
78%. That's right. Why do you think that's the case, and what can we do to even improve it from here?
I mean, we have talked about this before, too, how women have really powered this economic recovery. Women coming into the labor market, women, doing jobs from all across our economy. And what we see is, in terms of economic trends, women tend to come into the labor market more when there are good jobs, when pay is higher. So that's another indication. But I think, the real story is also that we still remain behind as a country compared to other countries when it comes to women's labor force participation rate. And that is because we are the only industrialized nation that does not have a national paid leave policy. And we have a study that the Department of Labor has put out that makes very clear that if we had a care infrastructure and we invested in family supporting policies like paid leave, it could bring another 5 million or so women into the labor market to the tune of $775 billion in economic activity a year. So when women are able to work, when they are supported in their work, that is another sign of economic strength. And we are certainly seeing that, and we still have more work to do on it.
All right. Well, to be continued. Secretary Su, thank you so much, as always, for your insight.
Thank you so much, Jennifer.
We'll be right back. You're watching Yahoo Finance.
Stocks rallying this morning after April's jobs report comes in weaker than expected. Taking a look at where things stand right now, the Dow up 525 points, the S&P 500 up 62, and the Nasdaq up 306. We are seeing tech seeing the biggest gains on the day so far. That sector up well over 2.5%. Yields pulling back right now as we see the 10-year yield at 4.48% on the longer end of the curve, 30-year yield at 4.66. To break down the moves, we got Vishal Kanduja, Morgan Stanley Management Managing Director. Vishal, good to talk to you today. Let me just get your take on what we got this morning as we see the yields pull back on the end of it.
Good morning. Thanks for having me on. I think the report was spot on from what what Chairman Powell told us on Wednesday, continuing to rebalance with weak undertones. So it leaves the bond market almost at a point where it releases a lot of that pressure that was building up. There were three big things happening. If you look at just the microcosm of this week, there was the quarterly refunding announcement by the Treasury, again, a very benign one, a dovish FOMC, again, guiding us to that we are still hesitant about cuts, rightfully so, but then very confident that the next move is very unlikely to be a hike. So that releases another, a lot of pressure, and then not so hard in a very balanced NFP report here that we saw this morning.
So, Vishal, that release and pressure, I mean, what does that suggest in terms of where Treasury yields move as we see it pull back today? Are we going to continue to see it sort of closer to that 4% level?
I think closer to that, 425 to 450 is where the 10s settle down, in our opinion. The inflation data, as Chairman Powell and all the Fed voting members have told us, needs to do a lot of the hard work. And that's why we don't think that right now, I think the data is not guiding us towards a sub 4% on the 10-year. So I think around this 425, 450, pricing in about 0 to 2 to 3 cuts this year and probably another 4 to 5 cuts next year is where we think fair value should lie for both the front end as well as the 10-year here in the market.
How many more employment situation prints like this for the month of April do you believe that the Fed needs to see in order for it to firmly believe it has reason to cut?
I think 2 to 3 more of these consistent ones that you need to see that unemployment is not completely taking a leg higher here, that consistent slowing of the inflation pressure. And the number that I have in my mind on that one is that the wage pressures or the wage inflation, it's a positive thing for workers in the employment force. It's still higher. It's still running higher than the actual inflation prints in the market. So that is positive. But then that is the one that the Fed is also closely watching, and we are closely watching as well. But it ticked down this month about 6.7% quarter over quarter. If you look at the seasonally adjusted rate, again, it was much higher that was the first quarter one, and it's ticked down with this report. So it seems like that April number was a little bit of that strong blip that we had seen because the revisions that we saw in March. So we believe that another probably 2 or 3 reports like this, which should be then seeping into the inflation prints for the next 2 to 3 times, which guide the Fed a little bit more comfortably towards those cuts by the end of the year.
Vishal, what does that investment thesis look like for you right now, specifically in fixed income? Is it still weighted more towards corporate credit, or are you starting to mix things up?
Still very, I would say that still very constructive on corporate credit. I think we look at 3 fundamental things there, valuation fundamentals, technicals and valuations. We call it the FTV. We are still very bullish on corporate balance sheets here. Yes, dispersion is increasing, which is rightfully so at this time of the cycle. You are seeing certain balance sheets deteriorate. So as actively, if you can be away from those and then take opportunities in the ones that are fundamentally strong, but broadly corporate credit fundamentally is very, very, very strong. Technicals are immensely strong right now. I think just to give you a sense, year to date, we've seen about 60 billion of inflows in US IG. Along with that, we've seen about 640 billion of new issue supply, which was approximately about 4 times oversubscribed. So you had 4 times more demand, that's 640 billion. And then spreads are tighter on the IG credit. So technicals are very strong, but valuations is where we are a little hesitant at this point, where we were quite a bit more overweight coming into the year, about that middle of Q4, as we heard from the Fed. But our overweights have increased. So we are moving some of that money back into securitized credit. Some of these non-agency MBS bonds, borrowers who bought their homes in 2019, 2021, sitting on a lot of home equity with 3%, 30-year fixed rate mortgages. That's the borrower that we like at this point. And then parts of CMBS market, again, that got painted with a broad brush because of what is happening in commercial real estate. So that's attractive as well.
Some good takeaways there. Vishal Kanduja, Morgan Stanley Investment Management Managing Director. Appreciate you stopping by. Coming up, closing arguments in Google's federal antitrust case continuing today in Washington, D.C. We're going to discuss the implications for the tech giant on the other side. We'll be right back. Alphabet in the hot seat, the Justice Department taking aim at Google's search business, arguing that the company's search deals with browser makers like Mozilla and Apple illegally extended Google's monopoly. Let's bring in Alexis Keenan, who's been tracking the closing arguments. This is one that's dragged on for several weeks now. The expectation here is that this could really set a precedent for other big tech companies as well. What have we heard so far in these arguments?
Right. So this case is closely watched. It's going to have far-reaching impacts, perhaps for the tech industry, the broader industry, the wireless industry, because this is a huge case. This is probably the biggest case that the DOJ has brought against a big tech player since the Microsoft case. And now, of course, we have a stack of them, right, against all of our big tech companies right now. But this is just the trial phase right now. That's what's going on. And closing arguments arguments are set to wrap today in this antitrust case that was actually bought by the Trump administration. Maybe it will be finished under a Trump administration. Maybe it'll be finished under a Biden administration or other. But this is just kind of a first step. And what's going to happen once these closing arguments conclude is the judge is going to make a decision. This is not a jury case. And he has not so far tipped his hand, Judge Mehta, at the D.C. District Court. He's not really shown which way he's going to go here. But during the closing arguments, he gets the opportunity to ask both attorneys from both sides questions. And he has said things like, well, don't competitors bear some of the burden for competing in the search market? But on the other hand, he's also said, well, it seems very unlikely, if not impossible, that competitors could enter this market. So at the heart of the DOJ's claim here is that Google used illegal contracts. They had these layerings of contracts with companies like predominantly Apple, Verizon, Samsung, Mozilla. So you're talking about smartphone manufacturers, you're talking about browsers, wireless carriers, all mixed up in these contracts so that Google can get default placement of Google search on those devices. And the argument by the government here is that then from there flows all of this lockup of the markets for search in general, just a general search engine, as well as search advertising. Now take a look at that. That is the $26.2 billion, $0.3 billion that was revealed during this trial, that in 2021, that's the figure we have, that Google was paying across the board to these companies for this default placement. Now, the lion's share of that goes to Apple. Apple reportedly in 2022 getting $20 billion of that 26 or so $billion if you kind of go between 2020 and 2021 and 22 there. Then if you go back to 21, Apple had received $18 billion in those contracts. Go back to 2014, just $1 billion. So you can see how important these contracts, this flow of revenue is for not just Google, but for Apple and these other players. So a lot to be learned here once we see the judge's decision. That could come in weeks. That could come in months. We just don't know. But it is a first step. This is the trial phase. We should expect appeals.
Interesting. Alexis, thanks so much for breaking this down for us. A huge decision set to come forth from that judge. Coming up in the next hour, everyone, Madison Mills and Brian Sazi take our place for the new show, Catalysts. They're going to be diving deeper into what's moving the markets this morning. Moderating job growth. Is it enough for the Fed to consider cuts? And how will it impact the market's momentum? Plus, the three big catalysts for Apple. They'll reveal what those are and how they could each drive the tech giant's share price going forward. All that and much, much more. Stay tuned. You're watching Yahoo Finance.
It's 10 a.m. here in New York City. I'm Madison Mills alongside Brian Sozzi, filling in for our own Shauna Smith today. Welcome to our brand new show, Catalysts.
All right, from equities to commodities, we're decoding trends and uncovering the drivers behind today's market moves.
Our team of experts here to help you navigate all outcomes to make the best decisions for your portfolio.
It's Friday, May 3rd. Let's dive into the catalysts moving the markets today. It's Goldilocks. The job market added 175,000 jobs, coming in lower than estimates. The big number the Fed will be watching is wage growth, up 0.2% over the last month, lower than the estimate of 0.3%. The bad news is good news, print pushing stocks higher across the board this morning.
And Apple shares rallying following that record-breaking buyback announcement. iPhone sales still an issue. The buyback buying Apple some time while the market awaits the next catalyst for the stock, AI-powered products.
And Block, remember them, doubling down on Bitcoin. The fintech company saying it will invest 10% of its gross profit from Bitcoin products into Bitcoin purchases every month. Bitcoin is ticking higher, now over $61,000 on the news.
But first, today's biggest driver is the jobs report. What might be good for the Fed, not always good news for the everyday consumer. Wage growth taking a little bit lower, softer, I should say, in April, now at 3.9% over the last year, compared to a 4.1% growth that we saw in March. And Sozzi, it's interesting to look at this wage growth number because this is what my sources were telling me was the key thing to watch. They were saying we don't want to see wage growth ticking up. Obviously, it's still on the upside here, but we're seeing the pace of growth slowing a little bit. That is potentially good news for the Fed. We're seeing this market pricing in 2 cuts this year, up from the 1 cut this year that we saw earlier this week.
Well, my source, my mom, is still seeing prices up very, very high in the grocery store. I don't know if she's really seeing any prices coming back. But anyway, while you're seeing the market rally, and I think you nailed Madison, now you're back to that thinking, do you get a rate cut at some point this year? Now, I've been talking about rate hikes the past few weeks. I'll put it out there on the table. I don't think that's necessarily off the table yet. That's just my view. But again, this is a market looking for any indication we may get 1 or 2 rate hikes at any point in this year. And this report is something that ultimately fuels that narrative.
And it's interesting because we saw the employment cost index coming in hotter than anticipated earlier this week, leading to a lot of volatility in the market. We saw a spike in the VIX that day, downside, of course, in the major indices. And now it seems like that happened 10 years ago.
You know it's crazy, Madison. What, wages were up, 0.7% or around there? Yet you go to the supermarket and you see prices for chocolate up 10%. Something's not wrong. Like you're going broke buying chocolate. But
right.
I always laugh at this government data. It's a real joke sometimes.
Well, and questions remain about the data, but that's what we got to look at.
Yeah, I know, it's our job.
We got to be data dependent, like the Federal Reserve.
Ooh, nice.
All right, could this print be enough progress for that Federal Reserve? Yahoo Finance asked some experts just that after the numbers broke. Here's what they said.
Chair Powell said he needs a meaningful increase to unemployment, and we're not there at meaningful yet.
I think the Fed's going to be happy that wage growth is cooling, and maybe some of that heat they saw in the job market in the first quarter is moderating to some extent.
Our next guest saying that he is keenly watching that wage growth data point. And he joins us here right now. We've got Stephen Parker, JP Morgan Private Bank Head of Specialized Strategies. Steve, thanks so much for being here.
Good to be here.
Love the bow tie.
Thank you.
And the Nikes. So let's talk about this. Are we officially into Goldilocks zone? Are we out of any question mark on that?
I mean, I don't know that Chair Powell could have asked for a better report than what we got today, right? I mean, we got the cooling in the labor market, which is what we're looking for. Wage growth is decelerating, but still at a healthy level. So the growth picture still looks pretty good. But the inflation pressures seem to be coming off the boil. And he was pretty clear in his statements earlier in the week. Hike wasn't in the cards. Today just reinforced that case.
Isn't this the worst thing that President Biden wants to see? A job market slowdown, a report that misses estimates, but also prior month revisions to the downside too?
Well, the revisions were slightly negative, but at 175,000 jobs, that's still a pretty strong level, especially when you start thinking about this not just on a month-to-month basis, where there can be some noise in the report, but the average over the last couple of months still indicates a very strong labor market.
Why the slowdown?
A lot of the slowdown, if you look through the data, actually took place within government hiring. So that was one place where there was a bit of a surprise to the downside. I think that's probably less reflective of the overall economy in general. So that's another potentially positive sign. I think the rate that we were running at for the last couple of quarters, I think was probably unsustainable.
So I want to look at one data point, which is underemployment, this U6 number up to 7.4% from 7.3. This is a data point that looks at whether or not people are getting the amount of work that they're craving, right? How big of an issue is that when we think about company fundamentals and what that could mean for investors moving forward? Could that be a problem?
No, I don't think that it's a big problem. You know, the interesting thing is when you look at the high demand for labor that we've been seeing over the last couple of months, it's actually been met with a high supply of labor. So that's why we haven't seen the wage pressures necessarily manifesting themselves. I think companies are doing a good job in terms of finding the right equilibrium in terms of their ability to hire and find candidates.
So I'm curious, if we start to see the consumer buckling because their wages aren't keeping up with the pace of inflation, does that put a crack in your argument that there is a broadening that is going to be happening in the market if consumer names, for example, can't keep up?
Again, we have to think about the balance between the direction and the level. You know, wage growth slowed down, but it's still at 3.8, 3.9%. That's a lot higher than where we were pre-pandemic for a really long time. So I don't think that necessarily is going to be the thing that crimps the consumer. I think consumer spending can remain strong, confidence is high, and I think that's a good environment.
Those bullish the market, do they now need to root for bad data to be the catalyst for the next move higher in markets?
I don't think so. I think what we want to watch for, the worst case scenario was this stagflation conversation that people were starting to have over the last couple of weeks, where unemployment is moving higher, growth is moving lower, inflation is persistently sticky. We're not seeing signs of that. That's the environment that I think would take us to risk off. I think if we can get to a place where markets are more comfortable that the next Fed move is going to be a cut, that inflation is trending in the right direction, you can take that strong growth environment and a really healthy corporate earnings market, that can move us higher.
How should investors play the idea of broadening?
So we think a lot of the rally that we've seen over the last couple of years has really been led by the US. We think we're at a place where that can begin broadening out globally, and in fact, we're starting to see that. Markets like Europe and Japan, I think, present really attractive opportunities. It's a place where a lot of investors are underexposed because the US has done so well. There's a really good story. You think about Europe, we think the growth is about to start reaccelerating. The European Central Bank is likely to start cutting rates before the Fed. And the corporate sector is actually starting to deliver on earnings, buybacks, higher dividends. It's a really compelling opportunity.
Well, thanks for swinging by Yahoo Finance headquarters on a Friday. Stephen Parker, JP Morgan Private Bank Head of Specialized Strategies. Really appreciate it. Thanks so much. All right, let's take a bigger bite out of those Apple earnings. Shares of the iPhone maker turned goggles maker are jumping as investors remain optimistic about the company's outlook, despite a soft quarter. But there are still a few big obstacles for Apple to overcome. Yahoo Finance's Inez Ferre is here with a few Apple catalysts to know about. Inez.
Brian, let's start with a catalyst the street has been talking about for a while now. Apple has seen sales declines in 5 of the past 6 quarters due to sluggish smartphone demand. Now, keep in mind, Apple's biggest money generator is the iPhone, accounting for about half of sales. iPhone sales dropped to about $45.8 billion in the last quarter, topping estimates, but a decline compared to $51.3 billion for the same period last year. Second catalyst, China. Analysts have been concerned about slowing demand there as consumers increasingly turn to homegrown brands. And however, China's results came in better than expected, with revenue decline there of about 8% versus expectations for 11%. Third, antitrust issues. In March, the DOJ filed a lawsuit against the company alleging it illegally maintains a dominance over the smartphone market by boxing out competing apps and devices. Now, Apple intends to fight that lawsuit. Despite all this, Wall Street is optimistic about the iPhone maker. The company has forecast a return to sales growth, with current quarter revenue expected to grow in the low single digits. And the company announced the biggest buyback program in U.S. history, a whopping $110 billion repurchases in shares, much bigger than the $90 billion announced in prior years, guys.
And as the number's so big, it doesn't even fit on the screen.
Once you get that big, it's like, whoa, it's up in the clouds.
All right. Well, thank you so much, Inez. We appreciate it, as always. Love to see that buyback there. One positive catalyst for investors focusing on for Apple is the potential for its AI growth. CEO Tim Cook on the earnings call, very quick to mention, which is unusual for him, the generative AI possibilities for Apple, saying, quote, "We believe we have advantages that will differentiate us in this new era." He cited the Apple's integration of hardware, software, and services, as well as its commitment to privacy. Saz, the big question that I have is, will this buyback buy Apple enough time to announce the AI-powered iPhone? I threw that in just for you.
No, it's really good. I will say this. I just put out a post on X looking at some recent comments by Tim Cook on AI in the last few earnings calls, he doesn't really say squat. He's like giving the market nothing. Right. He just mentions the word AI, and maybe something will come at some period. Whatever it is, I think it's safe to say we're getting some form of AI development from Apple, maybe in a few weeks, in a few months. Whatever it is, that's great. Now, I had a chance to speak to AWS CEO Adam Selipsky for Yahoo Finance's opening bid podcast. I asked him what customers want when they are searching for AI services. Now, this is a company doing real AI stuff at this moment, making a lot of money. Here's what Adam told me.
Say 15% of IT is probably in the cloud, which is a large amount because there's a lot of IT out there, but that leaves probably 85% of IT, which is still on premises. And the vast majority of that is going to move to the cloud. So those migrations and those transformations are reaccelerating.
So that is a major catalyst for Amazon in terms of AI. We know it. More companies moving their workloads from servers in a back office somewhere to the cloud that is likely to send really Amazon's business more than that $100 billion run rate that Adam told me about that they will hit this year. It's unclear really though, Madison, and I think you brought this up, what that catalyst for AI for Apple is. Is it a new bot on your phone? Do we need a new bot? How does it change your phone? It's unclear, but I think given the move in the stock price here in relation to what Cook said about AI, he needs to come out with clear, definitive explanation what this is going to look like for Apple and how they're going to make money off it.
And when you compare it to Amazon, they are starting to bear the fruit of their investment in AI with tangible results already, real product integration. It's still a story for Tim Cook. And the big question is whether or not on the developers conference day, I feel like the pressure is on for them to say something about an AI-powered iPhone, especially given that in China, you can get an AI-powered iPhone right now for less money.
What is an AI-powered smartphone? I've put this to Enrique Lores, the CEO of HP. He always comes on with us. I appreciate his time, but he is trying to sell AI PCs. What is an AI PC? Why do I need this in my life?
It's just integrated. Like I don't want to have to go to Google to type in.
So you just speak out. You just speak out like Madison Mills. Give me information. What is our favorite stock? It'll just pop up.
Yes.
Okay.
And I would love to. I don't want to have to type in ChatGPT on Google to get to the app. I just want to like have.
All right, you sold me on an AI PC. All right, you can catch my full interview with AWS CEO Adam Selipsky now on Yahoo Finance, or listen in on Spotify, Pandora, iHeartMedia, and of course Amazon Music. We'll be searching for more catalysts on the other side of the break. Stick around.
Let's do a check of the markets here, sponsored by Tasty Trade. Taking a look at gains across the board here following that less hot than anticipated jobs report this morning. You got the S&P up nearly a full percentage point. The Nasdaq up over 1.5%. Look at that. That is our jobs report, friends. That is a huge bump up that we're seeing in the market action this morning. I just want to take a look at the 5-day because it seems like that ECI print that we got earlier this week that led to these declines, that seems like it was centuries ago now that we are up in this market here. And just doing a quick look across the board at what we're seeing in the market action on the individual names, a lot of gains across your screen when it comes to big tech. Interesting to see that we're seeing a little bit of a sell-off in Apple stock this morning, particularly given the bump up that we saw after Alphabet's earnings over the past couple of weeks. I just want to take a look at how this stock did. Yeah, this is their earnings day, so coming off of those highs a little bit here, but seeing gains really across the board when it comes to big tech. Of course, Apple up over a little bit over 6% this morning following those earnings saws.
Crushing at that big board, double M. All right, we'll see you back in a second. Amgen shares, well, they aren't cutting the fat. The stock is surging as Wegovy could be facing a new hungry competitor. Wow. Yahoo Finance senior healthcare reporter Anjali Kamani has more on this. Anjali.
That's right. We know, of course, that Amgen coming out with its results, early results, taking a look at what its own obesity drug is going to look like, really telling the market that the competition that we thought was coming down the pike is in fact coming down the pike, and pretty shortly. While Amgen is not set to have its results until later this year and still needs to start its phase 3 trial, we do know that this is a market that has such a large addressable market, and we've heard from both the CEOs of Novo Nordisk and Eli Lilly say as much. Take a listen to what they've said in the past.
In the US, there's more than 100 million with a BMI above 30. So there's room for competition, there's room for choice. As long as products stay safe and they get, say, well above 15% in weight loss, I think you can have a serious play. And we have a very strong pipeline coming. We are already now in late stage development of our next generation product.
I think the question, if you look at historic performance, is will we be the leader who gave up the lead, or will we exploit the lead? There'll be room for others in various niches and so forth. So of course we want the second. And we're doing that, as I talked about, with successive innovation. We've got retatrutide in phase 3, or Forglipron, the oral, which is the most advanced oral program out there. We have 6 other clinical stage assets in obesity and the various manifestations. And I think that's where the game will turn next, is who's indicated for what.
So as you can hear, both the market leaders are already preparing for that competition. We know Amgen, for example, dropped its oral pill option, which is another area that's going to see competition. Pfizer as well in that space. So all the sort of moving parts of what this is looking up to be, we're starting to see that come to fruition. Eli Lilly, for example, talking about sleep apnea, they already have results out. And there are other clinical trials either by these manufacturers or other institutions such as NIH that are looking at what areas these drugs, these GLP-1s and the newer formulations can help. We've got, for example, infertility as one option. We know that has been interesting, as well as Alzheimer's, bone fractures, skin conditions, childhood obesity, as well as checking if these drugs are safe for expectant mothers and breastfeeding mothers, so post-pregnancy. And so all of that talks about what the large addressable market is. We know that already estimates look at beyond $100 billion for these drugs, and we're starting to see that ramp up happen right now.
All right, Anjali, thank you so much. Really appreciate it. Apple's struggles in China proving to be difficult for the tech giant to overcome. The iPhone maker had a difficult time fighting off a resurgent Huawei in Q2 as the company continues to face growth challenges, particularly with those iPhone sales. Now, in this quarter alone, Apple's Greater China revenue, which includes the mainland, Taiwan, Singapore, and Hong Kong, sliding 8% in the last year. With those woes coming from Beijing, stirring up trouble for Apple, our next guest is adamant on shorting the stock. For more on this, we are joined by Evan Tyndall, Byreme Capital co-founder and chief investment officer, here with us in studio. Evan, thank you for being here.
Yes, thanks for having me.
So obviously a record-breaking earnings print for Apple. You're still short on the stock. Why?
So I think fundamentally we see a company where you're paying a premium valuation of 27 times earnings. I think when we first shorted it, it was trading for around 30 times earnings, and this is for a company that's going to do less revenue in 2024 than they did in 2022. And so we don't really think the risks of their 70+ billion of China revenue and their potential antitrust risks around the services business and how they operate the App Store are reflected in that premium valuation.
You think Tim Cook's commentary on AI products is BS and it's not going to be an earnings driver?
It will be interesting to see if that can really drive a replacement cycle. I mean, you're seeing, I think, under the hood for the last 5 to 10 years, a replacement cycles lengthen. I don't know if either of you know what the new features were on the iPhone 15. I think
seems faster.
I think for a lot of people, it's the improvements are very much incremental and not necessarily worth spending $1,000 on unless your battery's dying. So we just see it as a single-digit type grower going forward and not worth paying.
What's your fair value right now? I have Apple at 184. What would be that point where all right, I'm going to exit this trade and maybe I just go along it?
I think for me, if it was trading at sort of a high teens multiple ahead of a potential AI replacement cycle, I think that would be compelling. But that's another 20 to 30% lower. I think.
You know what the 5 biggest buybacks in history are? Apple, Apple, Apple. Apple, Apple.
That's right.
When does that start to change your narrative?
So we were actually long the stock 10 years ago or so when the cash on the balance sheet was a huge percentage of the market cap of the company. But I think today, yes, it's a large buyback, 110 billion, but it's like 4% of the market cap. I mean, yes, that's great, but
I want more?
I don't know if it can. Well, I just don't. When a stock is trading at 27, 30 times earnings, I don't know if a buyback is really going to move the needle because just fundamentally, the earnings yield on the stock is less than a 10-year bond. So I don't see that as moving a 2.7 trillion market cap stock.
Does it pay to even rotate either? Does it pay to even make this trade, or do you follow the approach of Warren Buffett? And we're coming up on his annual meeting. I mean, he is about a 6% hold over Apple shares, and there's just buy and hold it forever and just avoid dips in the stock.
Yeah, I don't think. I mean, for us, we run a long-short portfolio where, we're maybe making more trades than the average person might do or it has to do. I think if you hold Apple long term, you're likely to make a positive return. I just think the risks are to the downside in the next year or two, as they struggle in China. And we offset that short position with long positions in smaller cap companies that are going to grow more and are much cheaper and are mostly outside of the U.S., mostly in Japan actually.
If investors think about Apple as part of their portfolio as sort of a staple, a dividend driver rather than a hyperscaler, is that view of the stock more positive for you?
I think it is. It's more positive, but for me, I would prefer to own really any of the other, just compared to the other large cap tech stocks. I mean, most of them have much larger growth opportunities. We're long Meta, which now it dropped on the recent earnings report, but it trades at around 20 times earnings, and it has much larger growth prospects, we think, in the near future, and are obviously much farther ahead on AI than Apple.
You're also short Tesla, and just hearing how you lay out your investment case for Apple, you must be expecting Tesla shares to get cut in half? I mean, they're fundamentally wildly different companies, and Tesla no way is Apple.
Yeah, I think there's obviously huge differences in both companies, although they do share the same sort of China risk and loss of market share in China. And yes, I think Tesla, we're short Tesla as well. And again, these are short positions that are small, 1 to 2% positions for us. But yeah, we could easily see Tesla dropping 50%. At that point, it would still be trading at a sales multiple of like 2 or 3 times.
What triggers that? Is it China, or is it just the U.S. EV market never comes to fruition?
With short positions with such a high valuation, I think you never know what can be the trigger. But a loss of market share as competitive car manufacturers come out with more and more EV models, and people realize that some of the promises about full self-driving and robo-taxis just always get pushed into the future. I think at any given moment that that can serve to kind of realize the gravitational pull of such a high valuation.
Is Musk's kowtowing to Xi Jinping something that could potentially be a growth area, particularly because 60% of EV sales do come out of China?
I mean, you know, being beholden to what is essentially a dictator, I think, is always a risk for any business. And the higher the valuation of your company and the more dependent you are on China for your growth, I think the more at risk you are there of the, you know, political machinations in China.
I want to end really quickly on something you said about Meta, because their AI spend got dinged by the street. Why is it that their AI capex was negative?
Well, I mean, I think anytime a company is making a large capital investment, you have to wonder what the returns are going to be on that investment. But I think what Zuckerberg has proven over the past few years is that he can be trusted to make, you know, smart investments when they come along, and they're going to grow more than 20% this year. So we're willing to give him the benefit of the doubt that those are going to bear fruit over the near term.
It's not easy to hold positions like this, but you carefully laid out your case, and we appreciate it. Evan Tyndall, Bairimi Capital co-founder and chief investment officer. Good to see you. We appreciate it.
Thank you, guys.
All right. Apple shares are jumping on the announcement of a record $110 billion share buyback. Now, let's just get to Barton Crockett here, who's been listening in on this conversation on one of the bears that on Apple. Bart, you just heard one of our guests laying out the case for why he's short on Apple. What's your take on that, and why isn't that the right play?
Well, look, I mean, our rating is a neutral rating, and we have switched to neutral. We were a buy rating up until the summer, and we downgraded pretty close to the peak. And you know, our thought on Apple is that it's a great company. There is a place for it, but it's okay to trade it. It's okay to own more, own less of it. You don't have to sit there forever. And I think that reflects the maturity. I think that this is a company that a decade ago was a juggernaut, and now is a consumer staple. And there are times when, you know, their product cycle and the consumer cycle and the market positioning is encouraging, and there are times when maybe less so. I think it's you know, a company that you want to be careful. You want to buy it at the right price. You don't want to underestimate them, but they're most interesting when they're on the edge of disruptive innovation, right? And they did that with the iPhone. They've done that with the watch. They've done that with AirPods. And now they aren't doing that with Vision Pro, and they've given up on their e-car. And so you're leaning into to artificial intelligence, Gen AI. And the question there is, you know, are they going to truly be innovative, or are they a me too, right? The locus of activity for AI is at Google. It is at Microsoft. We've heard very little about what Apple has been doing. And so it's really a show me story. Can they put up something at the WWDC in June that turns around consumer appetite for their devices, stokes more demand? Is that feature that you do remember, that you do crave, or not? And that's what the stock comes down to. And right now, we need to be convinced.
So if they announce an AI-powered iPhone, does that change your view?
It's not announced.
If they do announce it.
Yeah, but I think that's a given. I think they've essentially already announced. They said that AI will be in all of their products. What matters is the details, and what matters is, do they have an AI device that's compelling? It's one thing to say you have an AI device. It's another thing to deliver some use case that consumers want. You know, our survey work would tell us that there is an appetite. Consumers are interested in AI capabilities. And, you know, in their minds, conceptually, that can be a reason to buy hardware. They're more favorably inclined right now on the Android side of the universe. And the Samsung phone, I think, is caught fire and been a share gainer. And, you know, it's not clear that Apple can do better than that, or even can match it. But that's what it's kind of come down to. They need that excitement to come back.
Barn, any reading on yet if the goggles that they came out with are successful and they're going to be that next big product?
Look, I hear a lot of enthusiastic talk about it. I'm not in that camp. I do believe that the price point and the cognitive dissonance of slapping a computer on your face for that much money, and the need to get the developer universe to buy into apps that work on this device, it's certainly not meaningful now. I'm skeptical that it's going to be meaningful anytime soon, such that you need to have investment exposure to it today. In fact, I'm more worried that this ends up being, a long-term disappointment. We've seen this in some ways before, right? So we've seen Meta's push with Oculus, and we know that there's a niche of people who love it. And the price point that they're coming out with is not that niche. And we've seen a big wave in movie theaters, for instance, of 3D glasses, and a lot of investment, a lot of hype. It came, people tried it out, then it kind of went. And it's very difficult to get someone to slap something on their face, to pay a lot of money for it, with the state of the technology today. And, I'm skeptical, and I would not use that as a reason to buy into Apple. In fact, I've been leaning against that idea.
Barton, real quick to wrap it up here. Apple's saying iPhone sales fell only 8% in China. The IDC saying it was 19%. Who's wrong?
Apple is clearly right. They said their China sales overall fell 8%. They said iPhone grew, and they said everything else drug them down. It's the strangest thing I've ever seen, where you have high quality market researchers talking about unit declines for Apple in China, and Apple saying they're dead wrong. Clearly, Apple knows what it's selling, but it is weird, and I can't explain it.
Barton Crockett, Rosenblatt Securities Managing Director and Senior Research Analyst. Always good to see you. Appreciate you hopping on.
Okay, great. Thank you.
Block is betting big on Bitcoin. The fintech firm will flip 10% of its Bitcoin profit into Bitcoin investments, says billionaire founder Jack Dorsey. For more on this, we're joined by Dan Weiskopf, Portfolio Manager at Tidal Financial Group. Good to see you here. What type of risk is Block taking on by doing this?
Well, they're taking the market risk of Bitcoin, of course, right? But on the same token, they're managing that risk. It's not a huge risk for them because it's sized properly.
Right, Dan. It's really interesting, particularly given the kind of market reaction that we saw. I'm curious, what was your takeaway on that market reaction yesterday?
The market reaction from the earnings or from the process of buying Bitcoin in their treasury?
From the earnings print.
Well, their earnings print was great. I mean, they're running on all cylinders. It's very clear that the business model is working, and that's part of the reason why they can afford to take what, as you see it, a risk in buying Bitcoin. I think a lot of companies with good free cash flow that are growers and strong balance sheets should be looking at buying Bitcoin. And I'd actually highlight that back in 2020, I suggested that Apple buy Bitcoin.
Well, isn't the company, what if Bitcoin gets cut in half, Dan? What happens to Block?
Very little.
Why? Why is that? Explain, lay that out to us, because I think a lot of people are now going to say, hey, they see Block trading on Yahoo Finance. Block is buying this Bitcoin. Bitcoin is still up relatively high, over $60,000. What if it gets cut in half? Doesn't that put the balance sheet at risk?
No, because the balance sheet risk right now is $500-600 million. They've got 8,000 Bitcoin on their balance sheet. We're talking about them buying maybe 13,000 Bitcoin. And, there is risk with that, certainly, but there's also risk in the context of not managing your balance sheet for the risks of inflation. If you're just buying fixed income or buying your stock back, that's also a risk.
Definitely. Well, and it's interesting, though, there are risks, but when you look at this earnings print, 40% increase in volume gains for Cash App. You can see data like that across the board for Block. So an interesting print to take a look at. Dan Weiskopf, thank you so much for joining us. Dan is the portfolio manager at Tidal Financial Group. Now, coming up, sports betting app DraftKings out with their latest earnings. Their CEO is joining us on the other side.
DraftKings is out with their latest Q1 earnings, which showed the sports betting company's revenue increased over 50% year over year. For more about how the ever-growing sports betting market is doing, DraftKings CEO Jason Robins joins us now. Jason, it's great to see you, and thanks so much for joining us here on Yahoo Finance Catalyst. First and foremost, we got to walk through the quarter here and just get a sense of what was really driving this first quarter revenue growth of 53%. What was the catalyst for that?
I think it was a lot of different things. Virtually across the board, our KPIs was up. Customer retention was stronger than expected. Spend per player was stronger than expected. And really, customer acquisition performed incredibly well. So it was across the board.
Across the board here, and you really think about the environment that DraftKings is seeing right now, and especially as we get into some of the launches that you've seen most recently, sportsbooks in Vermont, North Carolina, efficient customer acquisition as well. Where are some of the regions that you've got on the docket this year for potentially being greenlit that could help DraftKings' business story here moving forward, especially going into an election year where, yeah, betting is going to be on the ballot?
You know, it's hard to say. Definitely think we'll get a few bills done this year, but I don't know that we'll get quite as many as we did last year. But, you know, I think right now a lot of states, because of the election year, sometimes that slows things down a little bit on the legislation front. That said, we're right now in the heart of legislative season. A lot of states are still in session, and it's super hard to predict. We'll see. Hopefully we'll get a few over the line this year.
And you think about the customer acquisition costs here. How has that continue to move forward compared to years past, where you've been in those cycles where you're welcoming on more users to the platform, but at the same time trying to retain them against some of your other competitors?
Well, really, you know, for us, customer acquisition's never been better. We had about a 40% year-over-year decline in our cost of acquisition, our CAC, in April. So, you know, as efficient, I think, as I can recall it being since we launched Sportsbook. And that continues to be the case as May starts as well. So really seeing strong performance now on the customer acquisition side. And I think in many ways, having more focus on the market, even sometimes more competition, actually helps customer acquisition because it brings more people into the industry.
What are you seeing in the current quarter right now as it pertains to the playoffs that we find ourselves in right now for the NBA, plus the Stanley Cup run-up as well here, and how that is passing through to DraftKings?
Well, this is a great time of year for us. You know, NBA and NHL playoffs really spark a lot of interest. We got baseball in full swing. You know, golf majors, a lot of them happen in the, you know, coming months. Masters obviously already occurred. So lots of good stuff. You know, combat sports have been great. We've had some great fights. The Tyson fight is coming up towards the end of the quarter. So really a fantastic sport calendar. And we also have the Euros this year and you know, the IPL, so a lot of different things going on that I think will be new and exciting for customers to bet on, and a lot of the old favorites as well.
Yeah. You mentioned the Tyson fight. Of course, Tyson going to be fighting one of the Paul brothers, and I mean, now this is an official sanctioned fight that is going to go on the records here. How much of a lift are you expecting now that it is an official fight? Not that it wasn't before, but now that it's going to go on somebody's record, both.
Well, that's everything, because I mean, that's a key factor in us being allowed by regulators to take bets on the event. So really a big, you know, I think turn that it got sanctioned. I think that's wonderful for the sport, but also really great for DraftKings and for our customers.
Yeah, we're running short on time, and I got to hustle to my finish. Going to try and squeeze in two real quick. First and foremost, as you think about your media partners that you've had historically, some of them now announcing their own product. I'm thinking about ESPN as well. What does that mean for the relationship between DraftKings and ESPN and Disney?
Well, we have a great relationship with ESPN and Disney. We continue to buy advertising from them. Obviously, they felt it was important to do a particular type of deal, and you know, we're very supportive of that. We also have a great relationship with Penn. We have deals with many states, so you know, lots of interweaving between different companies in the ecosystem. And I think, you know, same thing across all our partners. We have great relationships with all of our partners.
All right, now what about casino games? There's a lot of talk about that being part of the strategy going forward as well here. What type of additive do you believe that could be for DraftKings business?
I think that's a huge point of upside that not enough people really realize. That, we're in 11% of the country population-wise now for iGaming. That's still almost 90% remaining. So tons of upside there, and I think that's actually a larger market even than sports betting.
Are you able to quantify that?
Well, what we put out there in the past is that we believe at full legalization, iGaming can represent north of a $40 billion revenue opportunity.
All right, Jason Robbins, who is the DraftKings CEO. Jason, thanks so much for taking the time here with us today to discuss some of the earnings as well as the guidance going forward for the business. Appreciate it.
Thank you.
Thanks. Well, Starbucks earnings report out this week was a bit too bitter for investors to swallow, sending the stock plunging. We'll speak to an analyst on what the company needs to do to get back on the street's good side. That's right after the break. Stick with us.
Starbucks has been on a wild ride this week after its disappointing earnings report. Let's take a look at its stock price performance. As you can see right here, it's just really, really bad. Not a good week for Starbucks. Sales not good, volume's not good, China's not good overall. And actually, I should say the guidance not good as well. So you see that stock essentially go like this, boom, down like that, and all over to the side. Not good. It hasn't been necessarily great 5-year chart either for Starbucks. You can see really just treading water here, you hit the lows there, but really has not been doing anything. And this time period, I should note, is pretty interesting. You had Howard Schultz come back in here, known as the founder of Starbucks, even though that is not necessarily true. He bought it off 2 people that essentially founded the company. And then you have the new CEO, Lax Narasimhan, who's still trying to catch his footing. But Madison, it has not been a good week for Starbucks. Lots of, I think, concerns now creeping into this narrative if Lax is the right CEO at the right time. But if his strategies don't come into really kick into overdrive over the next few quarters, he could be looking for a new gig next year.
He absolutely could be. And as you mentioned, Sazi, Starbucks is seeing its worst post-earnings performance since the year 2000. The company's struggling to keep users engaged with their product offerings, particularly given some of their price increases not necessarily paying out for them. Citi restaurant analyst John Tower joining us to discuss. John, always great to speak with you. I'm curious, what is the first step that you think Starbucks needs to take to amend the downtrend that they're in right now?
Boy, first step. I mean, there's a lot of steps that probably need to be taken. But first one, aside from admitting the problem, and I think the problem you guys hit on earlier, which is average check growth has really exploded since pre-COVID levels, at least the way that we measure it. Last quarter, it was up about 50% on a cumulative basis. They, explained some of that away from the growth of cold beverages and food attach and some larger party sizes, but that's a big jump for the average consumer, just to know that relative to just 4 or 5 years ago, you're spending potentially 50% more every time you go there. So how do you address that? I think it's effectively dealing better, and maybe zooming out a little bit, realizing that they're effectively by footprint the second largest brand in the United States from a restaurant standpoint. And the second largest brand probably needs to have a value offering on their menu. I don't know how they gracefully do that in terms of managing through that, driving traffic while also preserving earnings and same-store sales over the next several years. But it does seem to be potentially the direction they need to go, at least in the United States. That's how you spur traffic, right? You start giving consumers reasons to come back more frequently, aside from just product innovation.
John, good to see you. You always bring your A game. It's Brian here. It's been a while. Good to talk to you. As an analyst covering Starbucks, I'm going to put this very simple. Do you want to see Starbucks making an energy drink and things that may look like boba tea?
Look, innovation is always important here. I worry that you're going to be opening up more. I mean, they're always competing, right, with other alternatives across beverage, right? So C-stores have already had energy drinks. A lot of their competitors already have energy drinks. So them offering it is probably good to get rid of the veto vote. I just don't know if it necessarily means that they're driving incremental traffic to their stores, which is what they need. They need more traffic coming in. And the risk that they're running is you're just getting, myself who's coming there getting a cold brew saying, all right, maybe I'll try an energy drink this time. But does that get somebody off their couch to go there rather than just grab, something out of the fridge that they might have already bought earlier in the week, or just brew some coffee at home, or grab some cold brew that they got from the grocery store and fill it up that way, or satisfy their need for caffeine that way. So boba in energy doesn't necessarily excite me, but maybe it'll get some folks to show up.
I'm not trying that. They let me down with that lavender latte. It's a freaking disaster. I mean, it's awful, John. But let me ask you this: that earnings call from Lax, that was a tough listen. Now he has settled into this gig. Now I don't expect you to tell me, yeah, he deserves to be sent packing. Maybe that's my job. But do you get the sense that he just may not be the right CEO at the right moment for Starbucks?
I think there's a lot of frustration in the investment community with what's happening, and investors want to hear a better, bigger, bolder plan from the company, perhaps some hard decisions around their path forward in the United States and in China, right? That market alone, it seems as if their business continues to be contracting, not expanding, and there's not a great justification as to why they're, adding more capital to that market, why they're growing there, and what the long-term plan is going to be to combat some of this low price point competition that's come in. So it's challenging, right? And I don't have a simple answer. I just know that a lot of investors are very frustrated right now, and they want a lot of hand-holding on not only what they're going to do from a sales standpoint, but the simple, quote unquote, simple things they can do from a cost saving standpoint. The idea of, hey, here's our plan for cost savings over the next several years, the gross number, the net number, and how it's going to waterfall through. And here's some very specific examples as to how we're saving costs at the store level, as well as at, across the supply chain, and what that means from a margin standpoint today versus the next 3 or 4 years. I think those sort of steps will help re-engage a lot of the investors who've just said, I'm not touching this until I get a better idea of what the heck's happening.
Well, also, John, a lot of consumers are saying, I'm not touching this when the latte is $8. What does that latte have to cost to get consumers back in the door and not, as Starbucks said, which there are questions about, keeping the latte in their cart and not checking out?
Yeah, I don't know the answer to that. I'd love to know what that threshold price point is to get consumers to come back. They are obviously trying some stuff starting this spring with opening up their app to non-rewards members for mobile order and pay, and alluding to the idea that on Mondays there's going to be offerings dropped to everybody. That's effectively their way they're going after discounting. We might just be in a tough period if they're not willing to lower prices or set up a lower price point and lower entry price point on the menu for customers. We might just be through this transition period over the next few years where, they hold the line on price and check, and consumers just have to readjust to this new environment or where their prices are, And that just means you're kind of in choppy traffic land for a while. And that means in order for earnings to grow, or at least hold steady, you've got to find cost savings elsewhere in the model. So I don't have a great answer for you on what that price point can be. I just know that today what they're charging is not an alluring, proposition to the average customer.
Well, on that note, John, enjoy your weekend of Dunkin'. I will enjoy my 64-ounce cold brew over at 7-Eleven, new tap machine system. I'm very excited about it. John Tower, Citi restaurant analyst. Always good to see you.
Thank you.
We are not recommending that you go to Dunkin' over Starbucks, audience. Okay, go wherever you want. All right.
Just saying. All right, switching gears, sort of, kind of. Berkshire Hathaway's annual meeting kicking off this Saturday. Apple is Berkshire's largest stock holding, so it'll be interesting to see what Warren Buffett says given the stock performance this year. We had on Barton Crockett from Rosenblatt Securities earlier in the show. This is what he had to say about Apple's expansion into AI.
You're leaning into to artificial intelligence, Gen AI. And the question there is, are they going to truly be innovative, or are they a me too, right? The locus of activity for AI is at Google. It is at Microsoft. We've heard very little about what Apple has been doing. And so it's really a show me story. Can they put up something at the WWDC in June that turns around consumer appetite for their devices?
I really love this conversation with Barton. We asked him, Madison, about the potential for success with goggles, and he was essentially saying no, he doesn't want to put a computer on his face. And maybe he's right. Maybe I just tape this thing to my face, and maybe these are like my goggles. But he makes a point. These things are expensive, and why do we need this junk in our life?
I've been saying for years that the girlies with makeup are never going to put the Vision Pro on. They didn't ask me, but
well, it leaves like a ring of makeup around it, right?
Well, just like
then I can't get one either. I wear makeup. I don't want
they
that.
didn't ask a certain subset of customers. But obviously, you've been pointing this out, which is a really great point, that we've got this Berkshire meeting coming up. Obviously, Berkshire has a lot to say about Apple. Really interesting point here. I want to take a look. Berkshire's 5.9% stake in Apple, worth currently about $157 billion, even with the fall lately. That is about $120 billion in gains for Berkshire just coming from Apple. So,
Big Daddy Buffett, he's not selling any Apple. He loves Apple. He loves those dividends. He loves the buybacks.
How bad of a bet
Warren
is
Buffett,
it?
you know why he's always smiling? Because he's collecting all these dividends from Coca-Cola, American Express, and Apple.
There you go.
But our very own Shauna Smith is on the ground there. I can't wait to see what she cooks up. I believe we're going to have a live blog, too, on Saturday morning on all things Berkshire Hathaway live meeting. Very pumped about that. All right. From conference to another conference. The Yahoo Finance team is about to descend into one of the glitziest conferences of the year, the Milken Conference, being held at the Beverly Hills Hilton. Former President Bill Clinton will be in the house alongside Citadel's Ken Griffin and former NBA great Magic Johnson. Kiko Fujita will be joining me in Milken to kick off our coverage Monday morning. And here's the Kiko with me right now. And I was already excited about this conference. There's a lot of key names, a lot of market movers in here. But for me, it really is Monday evening, Elon Musk, 5 p.m. I need to know what he's thinking about AI. I need to hear what he's saying about a cheaper Tesla. I just need to hear why he's laying off all these people.
And why he's doubling down on the robo-tax.
And that
There's
too.
so many questions. What is this, a 30-minute chat?
Yeah.
Too short to get a lot of questions
I don't think our
in.
producers are going to give us that, though.
I mean, you mentioned this is the glitziest conference. I always find Milken very interesting because of the diversity of the guests that come there. And anytime you get the headliners being Elon Musk and Argentina's President Javier Milei, you know you're going to get some headlines out of there. But there's some really key things I think we're going to be hearing about. The theme is, shaping a shared future. It is a very fragmented environment, whether it's politics, how we move forward on AI. There's the issue about climate, and we've got some big guests lined up out there as well. One of the interesting conversations, this sort of points to how Milken is. You've got John Podesta, who's the climate advisor, talking to ExxonMobil's Darren Woods. Just a taste of things to come at the conference.
Yeah, and really, this is the last big, I would say, conference like this ahead of the election. I know if there's a couple things to watch, it's what everybody says about the election, rate cuts, and then where markets are right now. So our coverage kicks off Monday morning. We're going to be live, really, Monday and Tuesday. Psyched to do it.
Excited for you guys. I
Yeah,
can't
thanks.
wait to listen. I know the interviews are going to be amazing.
Please do tune in, Madison.
Two amazing reporters on the ground. Oh, I'll be tuning in. It's
going to be a lot of fun.
Because we'll be airing it during our shows. Guys, we're going to do a final check of the markets here. You got green across your screen, still following that jobs report. The S&P up almost 0.9% here. The Nasdaq ripping here, up over 1.7%. Still looking at gains for Amgen, leading those stock gains for the day here so far. Now, coming up, Wealth is dedicated to all of your personal finance needs. Our very own Brad Smith has you for the next hour, so stay tuned for that and have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, the April jobs report. We'll discuss the data around salaries and what to do with your retirement accounts. And housing hurdles. We'll reveal how rising mortgage rates will affect your wallet. Plus, we'll break down what a university endowment is and how it can affect the cost of your school tuition. All that and much more on today's show. Let's kick off the show with something everyone cares about: jobs. April data shows jobs and average hourly wages grew less than the month prior. The unemployment rate ticking up 0.1%. And your average hourly wages are growing, but at a slower rate than the month before. None of those things are good for you, but these numbers are conceptually good for the Fed because weakening in the labor market may help aid their fight against inflation. So let's get into this with Phil Orlando, Federated Hermes Chief Equity Strategist. Great to have you here with us today. So first and foremost, let's just make the correlation here between why this jobs report and the weaker than expected print matters for the Fed and why people should be caring about how this weaker than expected print could actually mean a good thing for rate cut potential.
Well, the Federal Reserve, Brad, first of all, thank you very much for having me on the show. Federal Reserve, over a period of a couple of years, took interest rates up pretty significantly in order to bring inflation down. And the Fed's last rate hike was July of last year. Inflation's been coming down nicely over the course of the last 18 months or so. But in the last 3 or 4 months, inflation seemingly bottomed and started to go back up again. The base effects, we were rolling off the low levels of inflation and replacing them with higher levels, based upon energy, electricity, housing, food, wages. And so the Federal Reserve was getting nervous that inflation was starting to go back up, and their next move might have to be to hike interest rates again, which is something they didn't want to do. And today's number was a significant Goldilocks number for them, because the wage inflation number, both month on month and year over year, you talked about the 3.9% increase year over year. The month on month number was only up 0.2%. That would annualize to about 2.4%. So the Federal Reserve is feeling pretty good about that, because that means that they don't have to take interest rates up, and potentially it brings the prospect of them beginning to cut interest rates back on the table. Our view is that the Fed may cut rates once or twice after the election. There are FOMC meetings on November 7th and December 18th. So if the data continues to improve along the lines of what we saw this morning, and inflation sort of is off the table, then we may see the Fed begin to cut interest rates at the very back end of the year.
And so all these things considered, this is just 1 month's print, one data point for the Fed to take into consideration. And of course, a host of data points within this one print. But all of these things considered, it is just one print. So how much of a trend are they looking for in future reports to come out perhaps weaker than expected, like this one?
Brad, you hit the nail on the proverbial head here. That one aberrant month of data is a blip. 2 months are a fluke, but 3 months in a row, then maybe you've got a new trend here. And that's what the Fed's watching. If you look at the other data that we saw over the course of this week related to this morning's report, the ADP private payrolls that we saw earlier in the week, very strong. Initial weekly jobless claims that we saw yesterday, very strong, suggesting the labor market is growing very significantly. And then a couple of inflation indicators, the unit labor costs and the employment cost index that we saw at the beginning of the week, again, very strong, suggesting that wage inflation is continuing to spike. The numbers we saw this morning were very different than that, in a lot of ways inconsistent. So the Federal Reserve is looking at this morning's report and saying, hey, this is great news. But which report is right? Is it this morning's jobs report that's right? Or is it the ADP report, or the claims report, or the employment cost index, or the unit labor costs? The short answer is none of us know. So the appropriate thing for the Federal Reserve to do, which is what they did Wednesday, is literally nothing. Let's just stop and wait and take a deep breath and wait for a couple more months of data to determine, is one set of data a blip, or is the other set of data right? And what is the prevailing trend through the economy? Short answer is we don't know the answer to that right now.
And then just lastly, let's put some equity strategy on this as well here, Phil. Is there anything from today's reading that should be triggering the market reaction that we're seeing right now, or repositioning that investors should start to consider if we see more prints like this?
Well, the market's responding very enthusiastically to the fact that this morning's soft wage data suggests that the prospect of a rate hike is off the table and the prospect of rate cuts are back on the table. That's all good news. The market's responding well. But again, go back to what we just talked about a minute ago. Is today's data the real trend, or were these other data points the real trend? We're not going to know that today. It may take another couple of weeks, another couple of months. So the fact of the matter is that we were expecting some increased volatility in the markets over the course of the second quarter, over the summer, based upon the push and pull of exactly how the Federal Reserve is going to act, given whatever the prevailing trend of the data is. So today's rally it may be the right trend, it may be premature. So we would suggest that still maintaining sort of a cautious defensive position until we've got a better sense of directionally where's this data going and what might the Fed's next policy response to be, that may be the more prudent course of action.
Phil Orlando, Federated Hermes Chief Equity Strategist. Thanks so much for taking the time here with us this morning. Really appreciate it.
Thank you, Brett. Thanks for having me on.
Certainly. Let's talk a little Apple here. Apple shares are soaring after the tech giant announced a whopping $110 billion share repurchase program in its second quarter earnings. Apple also narrowly beating analyst expectations for earnings. But don't let this good news fool you. Apple is having a tough time. The company's seeing net sales declines in 3 of 5 categories, actually. iPhone sales, a critical part of the business, down 10%. iPad and wearables, home and accessories also falling. Here with more, we've got Gil Luria, who is the D.A. Davidson Managing Director. Gil, great to see you and grab some of your insights on this. I mean, help us add some context to this. Is this just better than feared in some respects here? The reason that we're seeing shares move higher, plus the additive of the share repurchase program?
Better than feared is exactly it. There were a lot of concerns, especially about China and the impact on iPhone. If you exclude a tough comparable from last year, iPhone sales were actually flat, which is much better than the worst fears were during the quarter and heading into the quarter. So that's all we're seeing today, is a relief around the fact that iPhone isn't declining even more. And it looks like they'll be able to eke out some positive revenue growth in the next quarter, in the fiscal third quarter. So there's a lot of relief there. Mind you, stock's still down for the year. It hasn't really done much in a couple of years. And that's simply because there hasn't been much earnings growth. They need to generate a lot more earnings growth, which starts with more than low single-digit revenue growth in order to get the stock going from here.
Typically iPhones are something that are paid off over time for a lot of customers as they're purchasing into their telecom service provider anyway. And so for Apple and the pricing mechanism around the product itself, does that need to move lower in order for them to see more of this cycle initiation or demand generation for that product?
Definitely, that would help. More lower cost offerings, especially in emerging markets, can help them increase their footprint and gain share. But really, in order to drive an upgrade cycle on iPhone, they need to add meaningful new functionality. The last time they added meaningful functionality was iPhone 12 when they introduced 5G. That is almost 4 years ago. And oh, by the way, the stock outperformed dramatically in the year after that, and it's really been flat ever since, as they've had immaterial improvements in iPhones 13, 14, and 15. There is potential for iPhone 16 to be that big if they add the generative AI capabilities that we're all getting excited about ahead of the Worldwide Developer Conference in June. If that's the case, iPhone 16 could be as big of an upgrade cycle as iPhone 12 based on feature functionality, which goes well above beyond having lower price point and expanding market share here and there. What they really need is this new functionality.
And of course, the iPhone's so critical to the ecosystem that Apple has. You could almost argue that it's the hub for that entire hub and spoke ecosystem for Apple and a lot of their customers out there who are also spending into services. I mean, that set a new record for its quarterly results here for Apple. Where do you see that continuing to be bought into by consumers? Do they need to add on to that services offering that they're putting out?
They do. But they also need an expanding installed base. So the services growth at 14% is great. It's still only a quarter of the business, so that can only contribute so much growth. That will drive growth going forward and it'll become a bigger part of the business, but only if the installed base grows can that generate overall growth. So they still need the ecosystem, to your point, which is anchored by the handset, and then adds other pieces to the ecosystem, the Mac, the iPad, the watch, etc. If that base is growing over time, even if a little bit, the services growth can be faster than that as they layer more and more services and expand their penetration in various geographies.
Gil Luria, who is the D.A. Davidson Managing Director. Gil, always a pleasure to see you. Thanks so much for taking the time.
Thank you.
Certainly. Well, as we were mentioning, Apple announcing a $110 billion stock buyback this week, the largest in U.S. history. Stock buybacks, what are they and why should they matter to you? Yahoo Finance's very own Julie Hyman here to explain. Hey, Julie.
Hi there, Brad. So let's go through here the different factors that go into buybacks and the effect that they have. Starting with, why do companies buy back their own shares? Well, when companies have excess cash, they can make a number of decisions as to what they want to do with that money, including, for example, pay dividends. But basically what they do when they buy back shares is they will reduce the number of outstanding shares, and they end up canceling those shares once they buy them back. A company can't own its own shares in that way. So it reduces the number of shares outstanding. You reduce the supply of shares. In theory, that then increases the price for each shareholder. So that's kind of how the stock buyback works. In terms of why companies do these types of buybacks, first of all, it can be a signal to the market that the company views its own shares as undervalued here. In terms of benefits for investors, if the company is buying back its shares, the shareholder gets that money, so that's a benefit. But in addition to that, it can tend to boost the value for the shares. Now, reasons, again, that a company does one of these is that it can be a signal that the stock is undervalued. That's the signal that the company is sending. The company might want to do it because they have some flexibility in terms of the amount they're buying, when they're buying it. When a company does a buyback authorization, it doesn't mean that they're buying back that total amount of shares all at once. It means they are authorized to go up to that amount, but they do it at different times in the market when they think that the shares have fallen to a level that makes them attractive. So it gives the company some flexibility. There are some tax benefits to do so, and you also have some, sort of technical effects of stock options that then the company wants to reduce the number of shares outstanding here. Tax implications here, shareholders, I should say, do have to pay capital gains taxes on the shares that they sell back to the company, and then companies in turn has to pay a 1% excise tax on buyback. So that is sort of the tax implications that people have to keep an eye on. I should mention that not everyone is a fan of stock buybacks as a structure. There are some critics who say that while it may give a short-term pop to the shares, over the longer term, companies might be better off reinvesting that money in their businesses to do things like research and development, to build more plants, to hire more people, what have you. But it does tend to be a pretty popular move in the short term and does tend to support stocks over that period. Brad?
Julie, great breakdown. Thanks so much for tackling all things stock buybacks here for us today. All your markets action straight ahead, plus even more wealth building on the other side of the short break. Stay tuned. You're watching Yahoo Finance. Let's do a quick check of the markets, sponsored by Tasty Trade. The Dow Jones Industrial Average up 0.9%. The S&P 500 holding on to gains of about the same on a percentage basis, 0.9. And the Nasdaq Composite, oh yeah, it's up big time, baby. 262 points, 1.7%. This all after the weaker than expected jobs print for the month of April in a bad news is good news type of move. That's exactly what we're seeing here play out in the markets here, as the markets are very much welcoming the possibility of a rate cut on the back of that. Well, the U.S. labor market cooled notably last month after the U.S. added 175,000 jobs in April, less than the 240,000 that economists had expected. But let's zero in on the tech sector for a second here. That industry seeing sharp decelerations in hiring in recent years, as well as slashing thousands of jobs this year. Just in April alone, some of the world's biggest companies, including Tesla, Google, and Apple, collectively cut over 20,000 jobs. This according to the latest data published by layoffs.fyi. For more on this, I'm joined by Paula Bracher-Ratliff, who is the Women Impact Tech CEO. Great to have you here with us today. Let's talk about some of the broader layoffs that we've seen within tech and what you're noticing, especially as it impacts women in the workforce.
Thank you so much for having me today, Brad. The implications of the data are pretty striking. We've had 4 years of significant volatility for tech workers. Most significantly impacted are the salaries. As we are starting to see things improve, you can't ignore that there's been a significant decline in salaries across the U.S. Our data shows that salaries have decreased for tech workers at about 12.1%. And the markets that are most drastically impacted are markets where we see tech hubs like Silicon Valley. They took probably the largest impact at about 15%, with other tech hubs like New York and Seattle following behind at 11 and 12%. Yes, you're showing the best news of the information that we're gathering, and that is that some smaller areas, less known for tech hubs, are gaining in salary increases. So markets that we're encouraging women in technology to focus on are markets like Houston, Austin, Phoenix, where we are seeing increases in salaries for tech workers across the U.S.
Yeah, it's actually remarkable. And I remember actually visiting all of these cities over the past several years and speaking with people about the number of tech roles and companies that were setting up camp. I mean, Austin naturally gets brought up with, of course, Google or Alphabet right in downtown area, and then the number of tech companies and jobs that get brought that direction. Tesla also setting up a factory there. All of these things considered, what are the types of roles that we're really seeing emanate in a lot of the inclinations that companies have right now to grow out their business?
Right, that's a great question. And what we're seeing some increases this year that have been a really positive influence. So we're seeing about 20% increase over prior year's trajectory and hiring for tech workers. And a lot of that has been powered by AI. So there's always been this concern, will AI cause us to lose more tech workers? And we're seeing the opposite effect. AI and other innovations are driving more tech need for organizations, and we're seeing improved hiring and improved hiring in the human capital space for tech because of AI and the impacts of resumes and resume writing. So I think for the tech sector, AI is definitely seeing a positive trend for them, and we expect to see that continue through 2024 throughout this year.
You know, you started to touch on this. Just want to circle back to it. The wage disparities that we're seeing right now in the tech sector, what is the leading cause of that from your analysis and what you're studying?
Yeah, unfortunately, we saw women in the workforce actually making improvements in gender equity as we came out of the pandemic. Unfortunately, over the last year, those small improvements that we saw have now leveled off to where when you look at the data across the board for the last 4 years, we're still seeing women make about 16.5% less in tech than their male colleagues across the board.
Paula Bracher-Ratliff, Women Impact Tech CEO. Paula, thanks so much for joining us here for this important conversation on the day and on the back of the jobs report. Really appreciate it.
Thank you so much for having us, Brad.
Certainly. Much more on wealth after the break, everyone. You're watching Yahoo Finance. There are reasons that many retirees move to states like Florida, Texas, and Arizona. Warm weather, great social scenes, and of course, low taxes. But are there more factors that retirees should consider? Our next guest here to help us answer that question. Welcome, Rhian Horgan, who is the Silver founder and CEO. Great to have you back here in studio with us.
Great to be back, Brad.
Let's talk about some of these places and what retirees should consider when they are kind of mapping or charting out where that next home is going to be to really settle down here. What is the top consideration you hear from a lot of retirees?
So I think the fact pattern is really changing. It used to be you collected your pension.
Yeah.
You sought out sunshine, and you were thinking about a pension, so you thought about state taxes, and it was pretty simple. Now you have to factor in things like Medicare, general cost of living, long-term care costs, and where your family lives. I think Medicare is a really interesting one because you think about Medicare being a national program,
right.
But the reality is half of Medicare is priced federally, and the other half, things like Medicare Advantage, supplement plans, drug plans, are actually priced based on where you live.
Right.
So there is a $2,000 difference per year from the most expensive state to the least expensive state in annual Medicare cost differences. So if you think about a couple, a difference of $4,000 a year in your budget is a real number to be thinking about as you think about where do I want to live.
So what regions is that pushing a lot of retirees to then?
So I think, historically, Florida was the destination that everyone was really focused on, and you still see a lot of appetite for Florida. But I think one thing that Florida is really challenged by from a labor perspective is actually the healthcare side of the equation. So Florida tends to be one of those places that is more expensive for Medicare. It's demonstrably more expensive when it comes to long-term care. So when you start thinking about perhaps needing kind of care later on in life. States like Tennessee are really jumping up in the list.
Interesting.
Yeah, and so
Dollywood, huh?
Exactly. So lots of culture, but zero state taxes, much more affordable cost of living, and the labor market is a little younger there, and it gives that ability to have like more labor to support actually the healthcare needs of retirees.
So how can retirees plan for higher costs and kind of budget for inflation in retirement?
So I think inflation is top of mind, obviously, given what we've been through in the last couple of years. And so a couple things that I think about. The first is don't underestimate how important your Social Security election is. You may remember from our last conversation, there's an annual inflation adjustment on Social Security. Yeah. A couple of years ago, that adjustment was 8.7%. So it was a real number. This year it's more likely to be in the 2.5% to 3% range. The second thing I would think about is, what's your bridge to Medicare? And part of tackling inflation is making sure you're not spending down your assets too soon. We see a lot of folks who still want to retire early, thinking about how do I go from full-time work to maybe part-time, and then fully transitioning to being retired. And so I think about that like 62 to 65 range is actually the most tricky because you are not eligible for Medicare yet. And if you retire at 62, you're gonna have to fund that out of pocket.
Right.
So what I see really savvy retirees doing is saying, I'm gonna find that part-time job that has really good healthcare benefits, and like by not tapping into my savings pool as much, able to keep growing my portfolio.
And I mean, the thing that a lot of people consider is whether or not they want to pick up a part-time job in retirement. I mean, it is retirement so that you can rest on your laurels of your career and hopefully sit back, relax, enjoy time with family, travel. And so if there are ways to make sure that you are still properly budgeting for retirement while at the same time saying, all right, if I do want to remain social or remain somewhat active in a career perspective, are there smart ways to go about that too?
I love talking to early retirees about how they've like hacked part-time work. And when I say hacking it is they're doing what they love and getting paid to do it. So it's like, you love to golf. Okay, so go work at the golf club and get your free hours
You're giving away my
driving
plan
range.
here.
Sorry.
Yeah.
Here in New York City, next time you go to the ballet or to the theater, take a look at the staff who's working in the theater, and they often tend to be older. And what they say when we speak with them is, well, I get to see the shows and I don't have to pay for them.
Right.
And so I actually think that's super interesting. And then you have like more practical, how do I get good healthcare benefits? And there's companies like, Home Depot, Starbucks that are just known for having good healthcare benefits and are always looking for folks to work more flexible hours.
That's a really good reminder. Rhian, great to see you again. Thanks so much for joining us on set.
Thanks for having me on.
Rhian Horgan, who is the Silver founder and CEO here on Yahoo Finance. Well, continuing with the retirement theme, when you leave a job, you have to think about what you'll do with work-associated retirement accounts, such as a 401k. Here to help us out, we've got Yahoo Finance contributor and Maconomics founder, Ross Mack. Ross, great to see you here on this Friday. So what do you do with old 401ks?
Brad, how you doing, man? Happy Friday.
Same.
I think a lot of people are stressed when it comes to their 401ks, right? Whether one, they don't actually know what they're invested in, right? Is it a target date fund? Is it money market? Or they just don't know in general. But then now, what do you actually do when you leave? And so one, there are four options, right? One, you can leave it there. It's not what I truly recommend, right? You could just leave it at your old employer. Two, you could actually roll it to your new employer. Three, you could roll it over to an IRA. And then four, you can cash it out.
So what's your preference from those options?
Well, when it's all said and done, right, the first and the last one are the two that I would definitely, not want you to do, right? And when you think about it, right, the average person is probably just going to leave it there because they're not thinking about rolling over. When you're leaving it there, understand this, you're no longer invested into that. So you're no longer able to benefit from the compounded annual returns, right? And then two, you want to actually say, I want to find a better way to make my retirement planning a lot more concise and a lot more easy. And how do you actually do that? Well, one, by rolling it over. So I always recommend rolling it over. I think you could obviously try to see if you could roll it over to your 401k. But the next thing is roll it over to an IRA, because now by leaving it at your old employer, you're no longer able to make contributions. So you're not able to get those compounded returns. But another thing to think about is if you do roll it over now, especially to an IRA, for instance, you're able to invest and have cheaper fees. You're also able to take advantage of many just overall lower fees and a lot. And I love IRAs for the simple fact that you have a breadth of more investments. Now you're able to invest in single name stocks, different ETFs, right? If you leave it over at your old employer, you're probably only going to have a list of about 15 mutual funds, which on average are going to have higher fees than a lot of the other individual investments that you can make with a rollover IRA.
And just lastly here, Ross, how easy, if you do leave it with an old employer, how easy is it to reassume that 401k and try to roll it over or combine it with your new earnings at the new gig?
It's fairly easy, right? What actually happens, right, when it's a qualified rollover, what you're going to do is just open up another retirement account. For instance, so let's just assume we're doing an IRA, right? So it's an individual retirement account. You yourself are opening that up. Well, what actually happens is that you're going to contact your old 401k provider, and they themselves would actually write a check to your new IRA provider. And so it's very easy, where they're literally just going to send a check to them, and there you have it. It will get deposited to your account, and now you're able to start making your investments for your long term. Going to have cheaper fees, and I would obviously recommend having another diversified portfolio.
All right, some actionable advice for some folks out there, and perhaps a little weekend activity as well. Ross Mack, thanks so much. Appreciate it.
My man, take care.
Good to see you. Well, coming up, everyone, mortgage rates just keep ticking higher. How are rates impacting home buyers and investors? We're going to dive into that next. Campus protests over the war in the Middle East have been top of headlines this week. And one of the proposals that the student protesters have been demanding is financial divestment from Israel. But we wanted to take a step back and really break down what endowment divestment means and why it's not as simple as it may sound. For more, we have Maddie Mills. So Maddie, let's start with the basics here. What is a college endowment?
Yeah, so when you look at university endowments, first of all, they differ from private to public universities. Private universities not required to disclose their investments that are part of those endowments. Public universities are. So just looking at what an endowment is, and we're going to pull a graphic up on this, they are funds and assets that are donated to the school, basically billions of untaxed dollars for the school, which is important, that kind of pile up primarily through donations, but also through taxpayers to a degree. And again, they come with a lot of tax breaks. Now, schools would argue that they utilize endowments for things like funding research, funding additional manufacturing, infrastructure, I should say, construction on campus, and again, those scholarship pieces. But students have questions about what the endowments are actually used for. And a big part of it, too, is colleges keeping a lot of that endowment so that they can invest it and grow that investment. And just taking a look at the amount of Columbia's endowment here in New York City is at over $13.6 billion as of June of 2023. Interestingly, not always great returns on these endowments. Columbia had a return of 4.7% over the past year, so not great when you look at the broader market, but that's what Columbia is at in their endowment right now.
So tie that background into the asks that we're currently hearing from students right now.
Yeah, so that is the big kind of complex question in the room, right? Because again, these endowments from private universities, they don't have to be disclosed. And even if they did, let's say that you were able to look through the documents from hedge funds, for example, and tie that back to some of these universities. A lot of these funds, very similar to any investment vehicle, they are invested in index funds or ETFs. They're not necessarily investing in individual names. So if Columbia hypothetically was investing in the QQQ, the Nasdaq ETF, a tech-heavy ETF there, they would be exposed to a name like Alphabet, which is going to yield big returns for them, particularly given some of the dividend plays that we've heard about in their earnings. But Alphabet is doing work in Israel. So does that mean that they have to get out of any tech funds? Is that part of the ask from students? It's not necessarily clear. Also, I should say Yale has been public about how high their bar is to divest from a company. They say that you have to prove that you're committing an egregious act of behavior that creates harm to others. If an endowment kind of does decide that an investment does that, it can take months to years to fully divest. So really complex and time-intensive situation for these endowments.
All right, breaking down the complexities of college endowment funds. Thanks so much, Maddie. Appreciate it.
Brad, yep.
Absolutely. Well, we're also tracking mortgage rates here on the day. Mortgage rates ticked higher for the fifth week in a row, now at 7.22% for a 30-year fixed rate mortgage, according to Freddie Mac. No sign of relief in sight for home buyers just yet. For more on the outlook for the housing market in this rising rate environment, we've got Larry Connor, who is the founder and managing partner of the Connor Group. Larry, thanks so much for joining us here. I mean, as we think about the mortgage rates, and we were just showing on the screen some of the figures that are really jaw-dropping for many who are trying to enter into the home buying market. How is this going to have an impact on the spring home buying season, even from your perspective?
Yeah, Brad, thanks for having me. So, interesting question. So typically in rising mortgage rates, as you might suspect, it closes out people from buying homes, and the net beneficiary is the apartment industry. An interesting side thought to that is that because there's more demand, actually higher interest rates can cause higher rental rates. Why? Kind of supply and demand. So when the Fed talks about, that inflation is stubborn, and specifically in the shelter area, and specifically there in apartments, that's part of the reason for it. Here's the unique phenomenon going on today. Right now in a number of our markets, we are seeing more concessions 2 weeks to 3 months than we've seen any other time in the last 5 years. So that's very atypical for what normally would be happening in rising mortgage rates.
Yeah, that's really interesting, and it speaks to some of where there's still kind of a push and pull, especially as the people who are trying to or want to be in the market to purchase a home are still being forced to rent, and that demand for the rental properties as well, which, I mean, you are a very successful investor in the multifamily real estate side. What advice do you give hopeful buyers out there as well?
Be patient. I think mortgage rates, maybe not over the next 6 months to the next few years, we believe will moderate. And think about this: apartment communities versus homes. Apartment communities, if you're going to build one, it takes 3 to 4 years from the time you start planning to you're completed. That's why the supply is delayed, and that's why in a number of markets like Austin, they're doing concessions because there's way too much supply of huge building between 2020 and 2023. The single-family home market is actually far more nimble, so they can scale up and scale down. So if there's a shortage, you can go find a lot and build a house in 12 months in most cases. Or if there's too much supply, you can cut it back. So our guess would be that come next year, home prices, which are up, I think I just saw something on Case-Shiller, they're up like 7.3% across 20 different surveyed markets. We think those will probably moderate, as well as interest rates.
And Larry, just lastly, while we have you here, given the fact that proliferating throughout social media, you often see some of the advice, the FinTalk or Finstagram advice from people who are investors in real estate property, but investors for the purpose of either being able to flip a property or collect rent on a property. For a lot of people out there that might be hearing some of that same advice show up in their feed, what are the things that they need to remember if they are going to have that type of assets that they hold on to and use as an investment strategy?
Sure. So if somebody says, hey, I'm going to buy some single family homes and use them investment, if you look not only the last 5 or 10 years, but the last 30 or 40, by the way, we started out doing that. It's a good, sound, fundamental strategy if you pay a reasonable price for the property and that you can get appropriate rent, enough that basically will cover your mortgage payment, taxes, and insurance, we think, on a long term. Right now, though, you may want to be careful because of elevated single-family home prices in a number of markets.
Larry Conner, who's the Conner Group founder and managing partner. Larry, thanks so much for taking the time here today to discuss the topic. Appreciate it.
Happy to be with you.
Certainly. Tiger Woods out with a brand new apparel line. You'll hear what the CEO of TaylorMade has to say about it next.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
At Augusta National Golf Club, where the annual Masters tournament is held, fans, both in person and virtually, would have spotted a different logo on Tiger Woods. That's because since ending his relationship with Nike in January, Tiger has partnered with TaylorMade to create his own signature clothing and apparel brand, appropriately named Sunday Red. I was able to catch up with TaylorMade's CEO, David Abelies, earlier this week to ask him about the newest era of their partnership with Tiger.
This is a massive launch that's taking place between TaylorMade, and you've teamed up, a partnership that you've already had for years with Tiger Woods on the equipment side, but now going into apparel. How did these talks start? Of course, it was after Nike and Tiger ended their partnership, but now you've got a fresh opportunity on the apparel side to really further the brand as well.
We sure do, Brad. It's you kind of have to pinch me from time to time because it's an incredibly exciting business opportunity, but more so the partnership that we've had with Tiger that really started with TaylorMade back in 2016 when he was transitioning from Nike equipment and golf ball into TaylorMade equipment, which was fantastic. And we had a chance to engage with Tiger, work with Tiger, and learn from Tiger. And over the past 7 years, we've done some magical things together. We've identified new technologies, new design pathways. We've won a Masters with Tiger. It's been one of the great comeback stories, and I think another one to be written here. So we've been very fortunate to align our interests, our partnership, and quite frankly, our personal relationships with Tiger and learn from each other to be better partners. So a small group of us, a few creative thinkers, got our heads together and said, how would we approach this? To spend some time with Tiger and his team to determine whether or not there's a real feasible pathway to bring an apparel and footwear brand to life at some point in time in the future that would represent not only his playing legacy, his current state as a human being like all of us, but importantly, build upon his future in a way that's broader than just the game of golf.
I was also able to ask David about Sunday Red's unique and virally discussed logo and some of the Easter eggs that Tiger fans can find within it.
So there were multiple iterations of multiple logos. And one of the things that we've learned from Tiger over the years is that when we do a lot of work together, he has a very discerning eye for detail, a bit of an abstract viewpoint on logo application, contemporary form. And so this logo started to get developed from its early stages in something that doesn't look anything like what it is now. But the beauty behind this logo, and this is kind of the unwritten inside baseball or inside golf scoop on the logo, is when we landed on the Tiger for SDR. If you look at that logo very closely, with intimate detail, and count the stripes on the Tiger, you know how many stripes there are?
How many?
There's 15 of them.
Yeah.
Those 15 stripes represent the 15 major championships that he's won.
And finally, with the golf world seemingly splitting up the best players between rivals PGA and LIV Golf, I wanted to hear how David views the current state of the game and the best way to ensure golf fans get to see the best players face each other as much as possible.
I'm an optimist. In fact, we have a value at our company. It's called golftimism. It's a made-up word, but anytime you walk into TaylorMade's headquarters or even Sunday Red's headquarters, San Clemente or Carlsbad, California, you'll meet a group of people that are very optimistic about the game of golf, where we are today, and very creative about where we can go. We call it golftimism. Crazy, but fun.
It's going to be my new handicap, by the way.
Yeah, so Brad, you're golf-optimistic as well, right? But I am very golf-optimistic. I'm very optimistic that the right people around the table, we've got smart leaders in this industry that are now sitting down, trying to navigate their way to build a product and bring a product to golf fans around the world that will be inspiring to us all.
My thanks to David Abelies for stopping by the Yahoo Finance studio and taking some time. David is the TaylorMade CEO. We've got a final check of the markets here for you folks as we're taking a look at the Dow, the S&P 500, and the Nasdaq, all of them in positive territory. The Nasdaq nearly up 2% right now, 1.94% to be exact. The Dow Jones Industrial Average, you're seeing that higher by about 1.1%, and the S&P 500, that holding on to gains by about the same on a percentage basis, 1.1% as well. This on the back of a huge employment situation day where the markets are evaluating exactly what's this mean for the Fed's next meeting here. Well, that's it for now. I'm Brad Smith. Thanks so much for watching Wealth This Week. We'll be back with you on Monday, 11 a.m. Eastern Time.